Assalamualaikum and a very good morning, ladies and gentlemen. We will now begin our session. On behalf of MIA and ACCA Malaysia, welcome to today's MIA-ACCA Train the Trainers Workshop, jointly organized by the Malaysian Institute of Accountants MIA and the Association of Chartered Certified Accountants. My name is Nur Atika from Competency Framework and Development Department of MIA, and I will be your host for today. First of all, I would like to thank everyone for attending this workshop. We hope this workshop will benefit all of you as well as students. We are excited to kick off the 17th series of our Train the Trainers workshop today. This session will focus on MFRS 9, Financial Instruments, a crucial topic in the ever-evolving world of accounting standards. The primary aim of today's workshop is to help lecturers strengthen their pedagogical approach and professional development. By enhancing the capacity of our academic, we aim to ensure that educators are well equipped to navigate the regulatory changes that shape the accounting field. As you may know, this Train the Trainers workshop is part of a collaborative effort between the Malaysian Institute of Accountants MIA and other professional bodies. It's designed to support the ongoing development of our academic, ensuring that lecturers stay up to date with the latest changes in accounting standards, rules, and regulations. A special thank you goes to ACCA Malaysia, whose continued partnership and support have been invaluable. Since 2015, we have worked closely together to deliver this workshop. And today marks the 70th series in our shared journey. We truly appreciate your commitment to enhancing the capacity of academic professionals. With that, let's dive into today's session. I'm sure you'll find it insightful and enriching for both your personal and professional growth. Enjoy the workshop. Without further ado, let's invite Mr. Selva to start his session. Mr. Selva, you may proceed now.
Thank you very much, Ms. Nurul Atika, and also thank you, Ms. Hasmida Ismail, for the earlier introduction. And welcome everyone today to the 17th session of the MIA-ACCA Train the Trainer session. As you have known, today we are looking at the financial instruments. Okay, here we go. So this is a little bit more detail on the MFRS, on the 9 relating to financial instruments, because we are looking at a slightly deeper than what it used to be just on the surface of the whole program of financial instruments that was done very, very, very much earlier. So here we are focusing on the credit risk impairment model. Now, this is a very important area because a lot of students may not know exactly what is this ECL or the credit risk impairment or expected credit loss, which is what ECL stands for. They might not really know, or they may very vaguely know. So what I'm going to do today is to try and attempt to see if I can put in some numbers and some examples to bring this whole concept of expected credit loss and the whole concept of credit risk to some form of a practical illustration, so we can actually see how it works in action. Because the theory and the standard is very, very, condensed, very packed, and a lot of words, but very little example. Even the application guidance doesn't give much of the example. So a lot comes from the practical side of things. So today I'm going to put in some of the practical issues, and then we see how we are going to move from there. All right. So let me just move the first slide. So I'm going to start with some kind of a preliminary thing on the expected credit loss. Then I will go a bit deeper. I will also go to the pre-reading notes that was given to you, because there are some of the explanations there are also very important to understand. So I will do it in parallel with the slides. right? So if it's all right, so you will see me switching from the slide to the pre-reading notes, which you already have. So now, since the topic is on expected credit loss, what is expected credit loss really? All right. And why did they come up with this concept of an expected credit loss? All the while, whenever we talk about, receivables which you cannot collect, the concept was to make a provision for the non-collectible receivable, right? So it is always based on incurred losses, meaning if you expect to make a loss and you're going to make a loss, you make a provision, right? But now we are not talking anymore about incurred. We are talking about a more forward-looking situation, which is called expected. Now, why does this come about expected? Why the change from incurred to expected? Now, let's understand what the user of the financial statements is looking for. And the users are all the various stakeholders. Basically, the banks who give the company financing. It could be lenders, other lenders, private equity or private debt lenders. For instance, you can have a private bond, or you can also have other creditors itself will give facilities to the company. They want to see the company how is going on, and also the shareholders, not to mention a variety of other stakeholders, including the employees of the company, even the debtors, or even any others, the wider range of people who may be interested in the company. Now, particularly, what are they looking for? Anybody who looks at a set of accounts wants to know, if I were to give this company money, or if I was to invest in this company, will this company survive within the next 2 years or 3 years? Or will it survive? Now, that question is packed with a lot of things that need to be considered before you can say, will it survive? The company may be very healthy, right? Robust sales and everything, and they are having business to business. They give credit. Don't forget, no company gives credit to individuals now, right? No more the olden days where they used to have the buku tiga lima, where you buy things and you write those olden days stuff. No more. Today, if you want to buy on credit, you use your credit card. All right. Nobody will say, okay, I give you credit. No, it's always on cash. But business to business is always on credit. So this is the issue here. When you sell goods to another business, right, and that business is very prompt in their payments. So you would think that, or always we would think that, oh, that is a very prompt payment customer. We are not going to make any provision for them. They always pay on time. Well, that could be a very good. But what if, consider this, and this has happened in the past. I'll give an example later. So what if that business has got problems in the industry in which they are in? The industry is going on a downturn, maybe. Competitors could be coming into the market, and therefore this company that you are selling to may be slowly losing business. And over time, they will end up in a situation where they may not be able to collect their debtors. That means your debtors who give credit to their customers also cannot collect, or maybe slow. So they will come into a situation where they can't pay this company. Whereas previously they were spot on paying on time, but now they are not able to pay. So then this thing becomes something you never anticipated, because we always think things go on well. We talk of incurred loss basis. Only when he didn't pay, we make a provision. We never look at the forward thinking. People who invest in the company, bankers who give money to the company are always looking forward. But financial statements somehow are very historical, based on the past. But based on the past does not mean the present and the future will exactly follow the past, because business goes through ups and downs, right? There are competitors in the market. There are so many factors that will cause business to change. But these are not considered in historical accounting. So now we are looking at something called the expected credit loss. It is not something you are going to incur, but you expect. Now that you have given credit to this customer who is very good in his payment, right? We also consider whether there could be a probability of any default moving forward, because their business might be getting into certain kind of difficulties, which we don't know. We only will know when payment becomes slower and slower and slower. So we don't wait for that, because that may be too late. So we anticipate, all right, we anticipate a certain amount of loss, even for the best of the credit debtor, right? So this is what we call recognizing the loss or the credit loss based on an expectation, not on an event that has occurred, and hence the term expected credit loss. So we are going to actually anticipate losses from this debtor, not wait for him to default. He may never default, doesn't matter. But what if he does? Are we going to suddenly, oh, I didn't know, we didn't know he was going to go into problem. So we anticipate, don't wait for the default. So it becomes what they call, we incorporate into expected credit loss something called the probability of default. All right, now we come to probabilities. What is the probability that they will default? It can go from a percentage from 0.5% of the debt to maybe even 100% of the debt. Normally not 100%, maybe it goes to 30 to 40%. The probability of loss, all right? Then we will look at it if the probability, eventuates, then we're looking at how severe could be the loss. So for all this, we are now as accountants looking at forward-looking macro information, big picture information, forward-looking. And this is what students are required to know. It's not about the olden days provision for bad debts, and no, it's about forward-looking. All right? Sorry, I accidentally turned the slide. Yeah. So when you talk about forward-looking, it is based on an expectation, not on an event. All right? So when we talk about this 12-month expected credit loss, as you see on the slide, let me put on the if I can get this, the laser pointer. I wanted the laser pointer. All right, so the definition is 12-month expected forward-looking are defined as the portion of lifetime expected credit loss that represents expected credit loss that result from default events that are possible within 12 months after the reporting date. All right, this is possible. So you have a 12-month expected credit loss. That means in the next 12 months, the lifetime expected credit loss, all right, maybe over time he may not be able to pay the full amount, but in the next 12 months, what is the portion of that lifetime, if I may put it in plain language, lifetime bad debts that represents the expected bad debts that result from default that are possible within 12 months of the reporting date? Possible. Not going to happen, possible. So this is not the same as loss or cash shortfall expected in the next 12 months. If you have expected, then you know it's going to be bad, right? But here is possible, right? It's possible. So look at the two words. Very important to understand the concept of expected credit loss. One is possible. The other one is expected. If a loss is expected in the 12 months after the reporting date, then you will put something called lifetime expected credit loss. So if your debtor is owing you, let's put small figures, 1,000 ringgit is a debtor, a receivable. And you know that this receivable within the 12 months, all right, he may not be able to pay everything. He will default it to a later date to pay. So we will have a certain amount of expected credit loss. We might all right, possible. Let's make a provision for about 10 to 15%. All right. And that is the possible within 12 months. We know that he will pay the rest. But let's make expected credit loss. He may pay the full amount, but we make in the next 12 months, let's say about 10 to 15%. That is a pure judgment, all right? A pure judgment. Now, this is not the same as loss or cash shortfall expected in the next 12 months. If a loss is expected in the next 12 months, if we know that, I look at his business, the business does not seem to be going very well. I don't think he will pay us the 1,000 ringgit he owes us. Now, after the end of the year, you look at it, I don't think he can pay. So it's not about 12 months expected credit loss. It is about the lifetime. That means the 1,000 ringgit is the lifetime. So you make a provision straight away for 1,000 ringgit. You don't make 12 months. You make 1,000 ringgit. Now, we don't normally consider this for trade receivables. This is normally done in the banking sector when there are so many loans and collectibles and a lot of variables, different permutations of collectability. All of these things, all right, will be considered, which I'm going to cover in the next slide. No exception under MFRS 9, except for those on the following slides. So no exception on this 12, except for two items, which I'm going to cover in the next slide. For the 12-month expected credit loss on initial recognition, 12-month expected credit loss must be provided for a financial asset carried at amortized cost, even if the instrument is high quality. Investment in bonds is also a financial asset. So again, what happens if the bond is downgraded? We will look at that as we go along. Okay. So now what are the lifetime expected, the expected credit losses that result from all possible default events over the life of the expected asset? Remember our 1,000 ringgit given to a person, maybe as a loan, let's say, and 12-month expected, we think that he may not be able to pay on time. So we put a 10% or 15% or 5%, purely judgmental, right? Purely judgmental, a provision called 12-month expected credit loss. Looking at it in the olden language is forward-looking provision for expected bad debts. That's not the term used, but I'm putting in olden day English. Provision for expected bad debts. But the language is called expected credit loss. Now, if you think that he even cannot pay the full 1,000, then we will put not 12 months, but lifetime. That means that whole debt possibly will never be collected. Remember, it is an expected credit loss. It does not mean it will eventuate. It might be collectible. But to be on the prudent side, we don't anticipate something we know may not happen at the time we make that decision. At the time we make that decision, we may know that it may not happen. Now, that is the crucial part of things, right? So that lifetime expected is defined as the expected credit loss that result from all kinds of possible events, default, over the life of the financial asset, the loan given. The measurement of the expected credit loss must be based on reasonable and supportable information. Now, these are important. That is available without undue cost or effort, that includes historical performance of that particular debtor, the current performance of that particular debtor and the forecast information on that particular debtor. All right. So this is a lot of information that needs to be analyzed and made into some form of a judgment. So that's why that measurement is based on reasonable and supportable information. It is possible to get his historical record. How was this debtor paying in the past? It is possible to get his current record. How is he currently paying? And then what is not possible to get easily will be the forecast. The forecast could be what industry is your debtor in? What industry? Then you understand the type of industry and the business that he is in. Is that industry going through a turbulent time? Is it going through a downturn? Is it something that there are new products that come into the market or new technology has come into the market that renders what your debtor is doing, his products are becoming a little bit obsolete, and he has not had the money to do R&D work in order to upskill his own company's product. So naturally, it'll be on a downturn, right? So this is what you call forecast information. So the student must be able to understand that we look at business not only for the historical, current, we look at the future. In fact, today, the future is more important than the past. The past is there. The foundation was there, but that foundation can be shaken moving forward, right? Sometimes you can even see that if Mr. Trump comes up with some tariff somewhere, suddenly there's a lot of shaking in the economic sector. All right, some companies or some countries and the companies in those countries may be affected. There could be tariffs. Their business will suddenly go down because cannot be sold. Now these are called the forecast information. All right, you don't need to go and get a specialist to find this. That's why they put the words without undue cost or effort. I mean, without undue cost means it doesn't mean just aga. No, there is a lot of information in the business press, in all of these publications which you will read, or the current news that you need to keep up with. And that will give you a good idea moving forward what is going to happen. All right. So like today we have all kinds of things happening in this thing, Venezuela. You also have Iran being threatened by America. Now, what will be this impact on your customer? If they have dealings with Iran or they have dealings with Venezuela or any other country around there, will it affect? So this kind of information, if you have been selling to them, you will expect to make a lifetime expected credit loss, right? Maybe, or you'll be able to make 12-month expected credit loss. Now, lifetime does not mean the full sum. The example I gave you, you have given a loan of 1,000 ringgit to a customer, all right? So you think that lifetime he cannot pay 1,000. Well, maybe he will not be able to pay 1,000. He may be able to pay 600 ringgit. The 400 cannot pay. So then the lifetime expected credit loss may only be 600. Once again, remember, a high degree of judgment and knowledge of the economy, the macroeconomics, is needed to make this kind of decision. It's not a debit credit situation. It's a judgmental situation which anyone sitting in the finance sector will have to make. Okay? Moving on. So I mentioned there are two exceptions to the 12-month expected credit loss. That means you don't need to make 12-month expected credit loss. You straight away go into lifetime expected credit loss. Remember there are two tiers, 12-month expected credit loss, lifetime expected credit loss. It does not mean 12 and lifetime, the entire debt is extinguished. No, maybe 12-month expected credit loss, maybe you say 2,000 cannot be collected. 200 cannot be collected. You give him 1,000 loan, and then the lifetime, another 400 cannot be collected. So altogether 600 you cannot collect. you still can collect 400. So the lifetime and the 12-month together is only 600. All right. So what are the situations where you don't provide for the 12 months expected credit loss? Like trade receivable. Now, to make it simplify, the standard has actually stated you don't need to provide for trade receivable under MFRS 15 or IFRS 15, revenue from contracts with customer. That means sales and trade receivables, right? Now, and that they do not contain financing component. Now, what do you mean by financing component? Now, if you sell goods to a customer, you will give him a normal credit period of either 30 days, 60 days, or 90 days, about that. All right. Now, if you sell goods to a customer and says, all right, this is a very slow moving product. And so I know that it's not easy for you to sell, but I want you to take a higher level of stock. But payment, I give you 2 years to pay. Right? That means I'm financing you indirectly for 2 years. So if I sell you 100,000 ringgit worth of stock today, payable in 2 years' time, then there is a financing component because you need to discount the 100,000 payable in 2 years' time to the current figure. So that contains a financing component, right? So that's why I say trade receivable or contract asset that result from transactions that are within the scope of revenue and that do not contain. If they do contain a financing component, 12-month expected credit loss is applicable. All right. If they do not contain a financing component, 30 days, 60 days, 90 days, right? There's no financing component. So then you don't need to make 12-month expected credit loss. What you need to do is only if you think that it cannot be collected, make a lifetime expected credit loss. So you have given him 100,000 ringgit loan, and then you find that his business is going down. He is paying, but his business is going down. So this is an expected credit loss. So you say that probably he might default after 40%. So 60% will be the lifetime expected credit loss. It's a judgment made by the company. Now, that judgment is based on macroeconomic factors as well and information that is available in the business news. You have to use all of that information, right? So when you do not contain financing or when the entity applies a practical expedience for contracts that are 1 year or less, provide for lifetime expected credit loss. Now, if it does not contain, then lifetime. If it contains a significant financing component, 12 months, payable in 24 months' time, financing component is there, then you have to provide for 12-month expected and also the lifetime. So in simple language, trade receivables, if they are payable within a 12-month period, all right, it's 30 days, 60 days, 90 days, even 120 days, there is no 12-month expected credit loss required for trade receivable or contract assets. Contract assets are those in a construction, all right, or in a property development sector or any other development. Whatever is done but not yet billed to the customer is called the contract asset. Whatever is received from the customer before a bill is rendered is called a contract liability. All right. Once the billing is done, it is transferred out of the contract liability, which is a credit balance, into the contract fees receivable. Right. Similarly, that portion of the contract assets, which are all expenses incurred but not yet billed, once they are billed or partly billed, that part that is billed will be transferred to the profit or loss. Those are called contract assets. By the same token, that will also be if you cannot collect your contract asset, you cannot bill because the customer somehow or other has gone into bankruptcy or is in a situation where he's financially distressed. Then you will provide again for that contract asset which can be billed but cannot be billed, you will write it off, and that becomes either a lifetime or 12-month expected credit loss. Okay. All right. Now, let me know if, on the, let me check my, uh, I'm looking at the chat box. Now, if any question, you can see, yes, the question was, is this a general provision? It is a very specific provision on specific debts. All right, you don't take a general one. So you'll go debt by debt. Let's say you got 10 loan debtors. We put small figures, easy to understand. Bankers have thousands of, right? So if you have a, 12-month expected credit loss, it is a provision for the specific debtor in that 12 month, that 10, maybe only 5 of it. It's, I would call it a general provision, but in a very broad term, it could be. But that is quite a misnomer. The correct term is 12-month expected, because you are expecting, you have to say the word ECL, expected credit loss. All right. So for trade receivable, last time we used PFDD, that means it is actually a lifetime. Yeah, you could be, it's a lifetime because the entire debt is provided for, it's a lifetime. But expected, remember, here is forward looking. What is already there, all right, provision for doubtful debts is a provision for doubtful debts on incurred loss basis. But expected is not a provision for doubtful debt on incurred loss. It is on expected loss. So the difference between, provision on doubtful debts is on incurred and ECL is on expected. Right? If the trade receivable is having a going monthly billing and payment, how can we apply this? You will have a actual rate of default. You'll have a matrix done for all your debtors, all your all right. If you're talking about trade receivable, normally trade receivable you don't do the 12 month, you do the lifetime. All right. So lifetime will be, what would you expect your customer business to do? Is it going down? Is the industry having a problem? Or are there competitors coming into your customer's industry? And therefore, you anticipate that the receivable may not be wholly collected. Maybe it'll be fully collectible, but you anticipate. So that is the difference between, a monthly payment. You make a provision. You make a small provision based on a matrix, right? Based on a matrix, and that matrix may be 0.5%, 2% is a judgment. So we make that provision in the event he doesn't pay. All right. So that's a 12-month expected billing. The tax deductibility, nothing to do with tax, because when you're talking about tax only gives on actual bad debts incurred. No provision, no expected. All these are added back for tax purposes. But for financial reporting, you want to know the actual situation, what can actually be collected if the worst possible scenario happens. That's why tax will not. Does it contradict with recognition provisions? No, it does not contradict with 137, because you look at MFRS 15, it's a standalone. It does not cross over to 137. All right. So therefore, you will not take 137 into account here. You will follow the specific provision in the expected credit loss. So is the direct write-off of bad debts? Yes, that is on incurred loss. Only on incurred loss you can write off bad debts. But expected for future, you cannot write off future. You can only anticipate and make some kind of expected credit loss provision, right? So it seems that this expected credit loss is not a genuine investment loss for banking. Is this their operating income? I believe it's deductible if realized, but it's non-banking financial. This is investment you realize. Now, no, you see, you're saying that it's an anticipated credit loss. Well, the word genuine investment loss, I wouldn't say it is the right word. It is an expected investment loss, right? Their operating income will be affected because otherwise they are overstating the operating income. It is deductible if realized. Yes, only when the time has passed, because this is future, remember, only when the time has already passed and it becomes an actual non-recoverable debt, which in language or simple language is a bad debt, then it is allowable. Otherwise, it's not. Now, if it is a non-banking financial industry, investment loss is also realized. Now, this investment loss is a provision. If you have an investment in a bond and the bond has been downgraded, all right, then you are making an investment provision here, all right, loss. Now, this is not a realized loss, right? Not realized, but you are reducing the profit that is distributable, all right? So that is an investment income loss, right? So it may not be revenue if it is not the business of the company to only do investment. If it is an investment business, then it becomes revenue. But if it is in a other business and revenue is part of it, then that will be only a part of it. All right. Now, just to clarify, ECL can be considered as an individual impairment or collective impairment. It is, you have to go individually or on debtor by debtor, right? And then the total is collective future impairment, right? Collective future impairment. It's not the current impairment. A current impairment means on the current balance sheet, you already know it's impaired. If you already know it's impaired, then you got to put lifetime expected credit loss. All right. Or you will have a bad debt written off. If you know it's impaired, you will write it off. Expected means you expect. So both 12-month expected and lifetime expected are not yet incurred. Right? So it is not an impairment that is incurred. It is a form of a future impairment. Only when the impairment is incurred, known that it cannot, then the 12-month becomes a total write-off. That's what it is. All right? Okay, good. Now, I'll carry on. Keep questions coming. I'll answer them as I go along. So the next item will be lease receivable that result from transactions within the scope of MFRS 16. So again, lease receivable is something that you can, you know very well in a lease, all right? There is operating lease, you have a lease receivable. If you own the asset and you are going to rent it out to people, that's a lease receivable. That lease receivable is again just like any other receivable. You may have a problem. So you don't make 12-month expected credit loss. You use the lifetime expected. So these two are the exceptions to the rule of 12-month expected credit loss. Trade receivable, lease receivable, not necessarily to do 12-month expected credit loss. You only do lifetime expected credit loss. All right. All right. Moving forward, the impairments. Now we talk about the impairment, the future impairment. This is so general model of MFRS 9 impairment are recognized in 3 stages to reflect the potential variation in the credit quality of the financial asset. So just now you mentioned about individual impairment. Now let's look at that word in the context of the 3 stages. Stage 1, items that have not deteriorated significantly in credit quality since the last initial recognition. For these items, a loss allowance, all right, this is the expected credit loss, equal to 12-month expected credit loss is recognized and interest income is calculated on the gross carrying amount of the asset without reduction for the loss allowance. Meaning, let's say you have given a loan to a customer. So the loan bears interest. So you are going to receive interest. But you know that there is a certain amount of loss allowance that you have provided, expected credit loss, right? So you have given him 100,000, expected credit loss may be 10,000, all right, for the 12-month expected credit loss. I will talk to you about how to come up with all this in the coming slides, but just take it first. Your expected 10,000 will not be collected out of the 100,000. So, but the whole loan of 100,000 is still subject to interest income. So what this sentence is saying is, you will make that 12-month expected credit loss allowance. That means minus 10,000, you got 90,000, but the income is calculated on the 100,000. The interest income continues to be calculated on the 100,000. not the 90,000. That means without the reduction for the loss allowance when it is in stage 1. All right. When it moves to stage 2, what then is stage 2? Items that have deteriorated significantly in credit quality. Let's look at stage 1. Items that have not deteriorated significantly. Not deteriorated, but you expect. But once the credit quality has deteriorated, but that do not have objective evidence of impairment. So he delayed a little bit in the payment, but he's still very solid. Just because he delayed, there will be a deterioration in the credit quality. All right. But no objective evidence, or even no objective evidence that this customer is not going to pay the amount. So for these items which have deteriorated but don't have objective evidence of impairment, a loss allowance equal to the lifetime expected credit loss is recognized, but income is still calculated. So just now we provided 10,000 ringgit. Now we find that it's gone bad. So we are going to make a lifetime expected credit loss inclusive of the 10,000 ringgit. We may make 30,000 ringgit. We may think that it has been declared this thing. So before he default, let's make a provision in advance, all right, which is called the expected credit loss, which is a lifetime expected credit loss of which is equal to 30,000 ringgit. So therefore, 70,000 is still in the books. 30,000 is an expected credit loss. Now, for these allowance, the allowance equal to the lifetime, which is 30,000, is recognized, but the interest income is still taken up on the 100,000 ringgit loan. You do not discount it or remove that 30,000 loss allowance and only take up interest on 70. You take up for the full 100,000. All right. And this is where it turns into stage 3. All right. So items that have a objective evidence of impairment at the reporting date. Objective. Now, what is the difference here? No objective evidence. What's the difference between stage 2 and stage 1? They have not deteriorated in credit quality. But here they have deteriorated, but don't have objective evidence of impairment. When it goes to the next one, there is objective evidence of impairment, which means that he has started to default in the payment. He cannot pay. Ask for extension of time. So that becomes objective evidence of an impairment at the reporting date. For these items, a loss allowance of lifetime expected is recognized, and the interest income this time is only calculated on the net amount. So now, because it has deteriorated, the 100,000 for which we had already provided 30, we will think now that it looks quite bad. Maybe we will provide 60,000 ringgit as the expected credit loss in total. That means 40,000 he will probably be paying because his business is going down. So 40,000 will pay. So interest income this time, because on the same loan, we only take up on the 40,000. We don't take up on the loss allowance. We don't take it up. But of course, when all things come back, you will sue him for the full amount. But that is not another story. Now we are talking about actually you only take up. That's why you can see that for these items where there's an objective evidence or impairment, 60,000 in our example, a loss allowance equal to the lifetime expected credit loss, which is 60,000, is recognized, and interest income is calculated on the net carrying amount after the loss. 100,000 minus the 60 on the 40, you carry that. All right. So the amount of loss allowance will need to be updated every reporting date to reflect changes in the expected credit loss, and also the credit quality of the item must be monitored continually. That's why in banks, they monitor it every month, every 2 months, every 3 months. The amount of loss allowance may change when the credit quality of the asset remains constant. Even the credit quality may remain constant because of the effluxion of time, right? The credit quality remains constant. The possibility of defaulting may change, or it may improve. We don't know. Now, the question here is, what is the relationship between expected credit loss and impairment? Well, it is an impairment in the future. Impairment is something in the future. Expected credit loss is unexpected. So if you say impairment, the word used in the standard is objective evidence of impairment. The word impairment here, you should look at it in the context of, can it be collected? All right. We don't know. We are expecting it cannot be collected. Stage one, stage two, stage three. We make an expected credit loss because we say there is objective evidence of impairment. Now, if we make an impairment actually, that means to say we already know it is an impairment, but we call that expected credit loss. In a very loose language, it is about the same. But in very specific language of the standard, it is called an expected credit loss because that distinguishes what is incurred against what is expected. In a loose language, it is about an impairment. Now, if you put impairment in the balance in the profit and loss account, people might think that, well, this is really impaired already. But if you say expected, then I will make a slight difference in my understanding or the understanding of the reader of the financial statement. This is expected. This is already impaired because the word impaired is normally something is already impaired. So expected, of course, impairment can be reversed, no doubt about it, except for goodwill. Any other impairment can be reversible. And likewise, expected credit loss can also be reversible. But there is a very slight shade of meaning. But the words used in the standard is ECL, but when they describe the stages, they talk about objective evidence of an impairment at the reporting date. All right? So that's the best I can do to explain the two items. Now, moving on, movement through the stages. The item can move from stage one, which is you have no objective evidence of impairment. You can move to stage two when you have objective evidence, when there's a significant increase in the credit risk since the initial recognition. Significant increase. If an asset is considered to be very low credit risk at the reporting date, it can be assumed that the credit risk is not increasing. All right, has not increased significantly. An item will move from stage one to stage two, then it can move from stage two to stage three when there is an objective evidence of impairment. So look at this difference. Move from one to two, significant increase in the credit risk. Increase in the credit risk. But 2 to 3, evidence of impairment like default or delinquency, did not pay, pay late, or can't pay the interest, delinquency in interest or the principal payment. So it's only at this point, that is that stage, that any loss would have been recognized under the previous 139, but the previous 139 is no longer applicable. So the new standard, which is no longer new now, MFRS 9, right, does not follow this old method. It follows already. Because the assessment is by reference to credit risk on initial recognition, when you give the loan to the customer, you already recognize a credit risk, regardless of the fact he can be a first-class paying customer. But economic circumstances for that customer may force him to be default, may force him to default. So we are anticipating the economic circumstances that will affect the customer. That's what we are looking at, all right? Because what has happened last time during the financial crisis in the year 2008, 2009, around there, what happened was financial statements were being produced, and investors were using that financial statement when suddenly the financial crisis brought a lot of assets down because couldn't be collected. So investors lost a lot of money and wondered, are the accounts really reliable on which you can base your investment decisions? Or are they just a set of historical numbers which does not take into account future economic issues? That's what was the question asked by the stakeholders. And that's why prompted the standard setters to have a look at future. All right, look into the future to see that in the event of economic circumstances that might affect or business might go down, competition may come in, new technology comes in. These are all very real in the real world. The business will go down. How come we don't anticipate this? We don't anticipate because we are using incurred loss basis, historical, when we should be looking forward looking information. So that brought that difference here. Forward looking. Because of that financial crisis, standards now began to be forward looking. Last time, if you ask an accountant and tell him, what about the forward looking? He will straight away scoff at you and tell you, what do you think I am? Am I a gypsy or something going through the looking glass, crystal ball and trying to look into the future? That was those days because everybody did historical accounting. Today, that kind of accounting is of no use. It's called pure bookkeeping, right? So financial, assessment, financial interpretation depends on financial statement that are prepared having regard to the real possible economic life of your customers, real possible economic life of your customer. And that's what brings what you can actually recover in your books into a smaller profit possibly, and that will be the real profit you can. Otherwise, suddenly, I declared all this profit, I declared a lot of dividend. Now the business has gone down. I seem to be in a negative position. All right. So that is the whole crux behind it. So because the assessment is a reference to credit risk on initial recognition, it is also possible to move loans to move from stage 3 to stage 2 or even stage 1. Once that person or that business recovers from whatever difficulty they are going to and starts paying back, then your stage will go from 3 to 2 to 1. And therefore, the loss allowance will be adjusted. So this is like an impairment, but impairment is more permanent. A little bit more. I wouldn't say it's permanent because you say assets are impaired. It looks like it'll be a more permanent, right? But the definition is not permanent. Huh? It's just that the difference between ECL is expected. Unless you put the word expected impairment. If you put the word expected impairment, then maybe it makes some sense. All right. Now I'm going into the credit risk impairment, expected credit loss model in more detail now. All right. So that was just the opening paragraph. So let's look at the introduction to the expected credit model, expected credit loss. Why expected credit loss? As I said just now, it replaces the old 139, which talks about incurred loss. Incurred loss is provision for bad debts written off. Actually, incurred, only you look at it. Provision is based on the possibility of collection. All right. So based on historical records, possibility of collection, not forward looking, historical. Right? But bad debts is actually not payable. So that's why it becomes the olden day method. Now it's been replaced with forward-looking expected credit loss. And the purpose of this is to recognize a credit loss earlier. This is the key word, earlier, based on reasonable and supportable information of the economy, of your customer, the business that the customer is in, the industry in which they're in, whether there is going to be competition, whether there is going to be, technological changes that will make your customer's business go down slowly and therefore making him difficult, which you now need to anticipate without spending undue cost or effort. Okay. But all of this information is clearly readable in the news today. All right. You can clearly read all these things in the news. So many businesses, many companies in different industries will have situations, maybe due to tariff imposition, maybe due to restriction to sell, where you cannot sell to certain countries. All these could be issues that come up, especially now. We are going through quite a turbulent time with Mr. Trump giving all kinds of direction, taking over countries. And this causes a lot of uncertainty in a lot of business that are dealing in international trade. So this is the future we are looking at. We are not going to wait for something to happen and then make a provision. So this is where we anticipate what the customer may go through. All right. So the core principle is entities must recognize an allowance for expected credit loss for all financial assets measured at amortized cost or fair value through profit or loss. Those are investments as well. Investments are normally measured at amortized cost, or they are measured at fair value through profit or loss, or fair value through OCI, depending on how you classified it on initial recognition, as well as for lease receivable, contract asset, and certain loan commitment and guarantees. Now, this becomes a little bit more complicated when we talk about guarantees. I'm not going to go into the guarantees here because this will be very complicated itself. A guarantee is relative to a loan. So let's look at the three-stage approach that we just covered. No significant increase in credit risk, stage one. No significant increase in credit risk. 12-month expected credit loss. Effective interest rate is the full amount. All right. Apply the interest rate on the full amount and take up the interest income on the full amount. No doubt, regardless of the fact you have provided for a 12-month expected credit loss. Now, when you have a significant increase in the credit risk getting a bit bad, then you will have a lifetime expected credit loss. Remember, I told you 100,000 may be significant increase, 60,000 may not be collectible. Then you make a provision for 60, only 40 is collectible. So in this case, effective interest rate is still on the full 100,000. You still take up the full interest. But it becomes credit impaired. Remember the term objective evidence of paying. Is not paying. Then you cannot take up the full effective interest rate. You only take up the interest rate on that 40,000. So the difference between 2 and 3 is that interest is taken up in full in true, but interest is taken up only on the net amount after the expected credit loss. 1 and 2, full interest. 3, only the difference. Okay. Now, what is the concept of significant increase in credit risk? This one, right? So this will be assessed on each reporting date. Compare the risk of default at the reporting date. Let's say now it is 30th June, let's assume, all right, 30th June 2026, right, versus the initial recognition 1st January 2026. What is the risk of default at the reporting date, right? And then we relook at it maybe at 31st December. If you are doing quarterly reporting, then you will look at 31st March, 30th June, 30th September, and 31st December, right? So you are going to look at the risk of default. So what are the indicators of the risk of default? So this is one of them. Significant changes in internal and external credit rating. Now, internal or external, if you find that if you go and do a credit rating on either CTOS or something, you find that this particular customer has other obligation which he has been defaulting on. Now, that will give you an indicator of significant adverse changes. And that is called significant increase in the credit risk. It might not be very much. He may be defaulting on some kind of loan or some kind of a hire purchase or something like that. Now, the other one is actual or expected deterioration in the covenant. So when the bank gives a loan to the company, there are certain covenants. You must maintain a certain current asset to current liability ratio, right? You must maintain a certain level of profit. For example, all of this. Now, if that current assets to current liabilities ratio is being breached, meaning current liabilities are going higher and the current assets are not increasing, so the ratio is being breached. So in that case, one of the covenants are being breached, it becomes a significant increase in credit. It has not come to the situation where the current assets and current liabilities become a negative current liabilities. No, it has become still positive, but it is decreasing. the margin is decreasing between the amount of the current assets and the amount of current liabilities, meaning current liability is slowly creeping up and the current assets is constant. It tells you a story that your liability is increasing, but you're not able to keep up with the payments on the liability to contain it within the covenants. So that becomes a significant increase in credit risk. All right. It has not come to negative yet. Sometimes past due greater than 30 days, that will become a rebuttable presumption. All right. Now, a rebuttable presumption means you can rebut it. So that is the very important thing that you got to understand. A rebuttable presumption. All right. You can rebut it. It does not mean that past 30 days means because it's a rebuttable presumption, it means it is bad debts. No, it is a rebuttable. Sometimes it could be delayed due to certain good reason. So if there's a good reason why it's delayed, then of course it is a rebuttable presumption. Even though past due 30 days, it's not a bad debt yet. But if it's known to be the business is a little bit slowing down, then that is where you will presume that the rebuttable presumption is not applicable, right? I'll explain to you a little bit on rebuttable presumption later. So national or world economic condition affecting the credit risk. This is what I say. Today, we have a lot of world economic condition that may affect credit risk of certain of the customers, not all. All right, certain customers may affect their credit risk. So these are indicators of increase in credit risk. Now, the 12-month lifetime expected credit loss, which he talked about just now, it's actually resulting from default events possible within 12 months. Possible. It may not happen. It may not happen. What if Mr. Trump puts a full embargo on certain type of goods where the customer is dealing with? Possible, but may not happen. So what if it does? We cannot say, oh, I think it will not happen. And when it happens, yeah, it happened already. How? We cannot collect how. So this is called default events possible within 12 months. We have to anticipate. A lot of judgment is required in the financial management stage here. All right. It's not just taking debit and credit. This is not about bookkeeping. So apart from the 12 months, the lifetime explained, expected credit loss resulting from possible default event over the expected instrument's lifetime. Possible default event. A loan is a financial instrument. All right. If it's a 5-year loan and there's going to be a possible default, then what is the expected possible default? We put expected credit loss on the lifetime. What we can collect is what we can. All right. So there are a lot of things that we are going to learn today. When we talk about possible, we need to understand something called the probability of default. All right. I'm going to show you after as an example as well. The probability of default. We'll talk about possible default events. You'll also look at loss given default. What is the meaning of a loss given default? They are not rocket science. All right. I'm going to make it very simple to understand what they are. So that will make it a bit easier. All right. So this is coming up in the coming slides. Then this is the 12-month. A simplified approach, as I said just now, is to exclude trade receivables, all right, without significant financing component, and lease receivable. If elected, you don't. So always measure loss lifetime. All right. So simplified approach is for these two, no 12-month expected credit loss, unless your trade debtor is over 2 years and you are going to give financing component inside there. Then yes, 12-month expected credit loss is applicable. But if it's a normal trade, a loan, all right, or this thing that you are going to give a trade within 30 days, 60 days, then you don't do 12-month expected. Similarly with lease receivable, right? So now here is where I'm coming to. How do you measure expected credit loss? Here we come a little bit deeper into this. All right. So the formula, just follow the formula. I'll explain in detail. expected credit losses, remember future, you got to first understand the probability of default, PD, probability of default. How do you determine probability? Coming to that, times the loss given default. What is loss given default? Even more weird, right? Times the exposure at the default, the EAD. These figures will be discounted at the original effective interest rates. Now I'm going to jump to this particular pre-reading notes in a moment, but let me finish this slide. Consider unbiased probability weighted outcomes. This is a probability weight this thing now. I'm not going to go into probability weighted outcome because that goes a deeper. All right. Let's understand the main principle first before we go very deep. Because once you go deep, you get stuck in the mush. Okay, we go step by step. So I will not touch on probability weighted outcome for today. Maybe in another session, if we are going through deeper, if ever, then we will talk about it. But I think this is not so important to teach the students now. Just tell them a probability weighted, how to calculate, they don't need to understand. Now, time value of money, we all know that, all right? If it's deferred, there's a time value. Reasonable and supportable forward-looking information. Now, this is where a judgment takes place. Reasonable and supportable, right? Forward-looking information. Anything forward, can it be confirmed? We cannot confirm anything, right? Out of common sense, we can never be able to confirm anything. So when we talk about, uh, supportable forward-looking information, it is assumed that you are going to look at something in the future and make a judgment. All right. Now, before I go on to this, there's a question, I think. For us to recognize significant increase for EACL, do we need to get confirmation from the related party or based on internal observation and tracking? Now, if you're talking about related parties, I would assume you're talking about related party transactions. You don't need to get any confirmation. You have to make a judgment based on your internal and external observation and tracking, not only internal. Your internal information is based on external information as well. The economic environment in which your customers operate. That is what you need to do to recognize significant increase. So significant increase means there is possible default coming on. So why is your customer having a possible default? Is possibly facing economic problems because of customers of customers of your customers are not paying, or they cannot sell, or there are some embargo on their goods, or there's some tariff which they cannot sell, which previously they could. All these are the things. So you're looking at external as well. All right, internal and external. A related party is, I don't think related party comes in here. All right, no doubt related party is a financial instrument, a trade receivable, is a receivable, sorry. So you want to know whether the receivable needs to be provided, then you have to understand your business of the related party. They are not going to tell you. They are not going to say, oh no, we are facing problem, we can't pay you. Because the minute they tell you that, it's a bad debt already. It's a 12-month expected credit loss. They will say, no, we are a little bit okay, and nobody will tell you that. Or they tell you, yeah, we are facing some difficulty. If they do say, then you have to consider that lifetime expected credit loss, because facing some difficulty is a very vague word, right? By normal human language, they will never say, yeah, we are going to close down that. I don't think they will tell you, because you won't give them some more facility or anything that you need to. You may have a big problem. You may recall the facility. So they will not tell them psychologically. You got to understand and find out. All right. Now, to understand all of this probability of default, loss given default, I will now move on to the notes that I've given to you. So there it is easier to look at. All right. I think all of you have this particular set of notes. This MIA-ACCA train the trainer pre-reading notes. Now inside here, there's some useful information. We may, if there's time, we'll go through this, but I'm going to go particularly into further down on this probability of default part of it, right? We go through it. All right. If you look at page 8 of your notes, page 8 of your notes, here we are looking at the uh, explanation on what is the probability of a default. So what is it? Okay. So what is the probability of default? Stands for the estimated likelihood that a borrower will default. You look at the word estimated likelihood. Nothing is certain. Will default on their financial obligation within a specified time horizon. So if you're talking about 12 months, it's 12 months. If you're talking about lifetime, it's lifetime. But the word is probability of default. Now you need to explain this to the student, because if you don't understand this, they will not understand the concept of ECL. So the characteristic of the probability of default, all right? Definition: the percentage chance that a borrower will fail to make the payment. Where do you get that percentage? It's not shown anywhere, nothing. It's a judgmental call. Is a judgmental call. Okay. Time horizon. So if you're thinking of 12-month, all right, probability of default for stage 1, or lifetime probability of default. Remember, just now we went stage 1 goes to stage 2, and the worst is stage 3. So, sorry, 12-month probability of default is for stage 1. All right. There is some deterioration, but no objective evidence of deterioration yet. But you can see deteriorating. So that is 12 months. Once you get objective, you will go into stage 2 and 3. That becomes lifetime probability of default. Now, the range is expressed as a percentage between 0% and 100%. There is no 0%. Everything has a possibility that it may fail. All right. No, not like before. Oh, this is a new debt I've given. This debt 100% can collect one. All the while he's paying 100%. It does not mean like that anymore in financial reporting. There is no 0% that he will not pay. There is always a possibility of default. All right. Or a probability of default. And that's the difference between the old and the new. It must be forward looking. Forward. Don't look at back. Must incorporate current condition and reasonable forecast. So it's a judgment on all of these, right? It's a judgment. The judgment is to preserve what is reported to the stakeholders. You don't want the stakeholders to get a overly, positive expectation of a company when it is not really that much positive on all of the items on profit and loss account, balance sheet rather. So you must give a more reasonable figures in this thing. What can be collected reasonably? What may have a problem to be collected? We need to provide expected credit loss. A lot of judgment, right? Now, how is the probability of default estimated? So here's where we go to the nitty-gritty. I'll go slow. Let me know if it's too fast. Right? So how is it? Internal risk rating models. This is normally done by banks, financial institutions. They have their own rating system. All right? So each rating grade is assigned a probability of default. Now, AAA will never be 0. It'll probably be 0.1%. A rating of double B could be 3.0. Now, this depends on the internal rating of individual financial instruments and bank. So this is between inside the bank. You cannot anticipate. Some may have AAA. They might adjust the rating from 0.1 to 0.3. And as the economy is a little bit shaky, or rather world economy, not necessarily Malaysian, because you're giving loans to a company which is dealing maybe internationally also. So they could be affected. So it may go from 0.1 to 0.5 or 0.8. So it is an adjustable thing, either every quarter or every quarterly. I mean, a half yearly. right? So this is internal. Then external credit rating. Map the agency's rating. So you look at all the Moody's, S&P, RAM ratings, etc., to the probability of default. For example, triple A or big A, too small a, maybe the rating is 0.05%, right? Double A, big A, small a, maybe 10%, 0.10%, sorry. Having a single A, then the probably a default may be set at 0.25%, and so on here, until maybe you come to a rating of triple C or C with an A, 25%. You see how that rating? So you have to have your internal rating as well as look at external rating to understand a probability of default of a loan given to a customer. Future, looking in the future, right? And then we go down further. Statistical model. You can do a logistic regression model, or you can even do a survival analysis, or you can use AI with machine learning to actually map the possibility of default. Now, they all become too complicated. You don't need to explain in detail to the student because these things will change from time to time on different institutions, but they must understand the logistical regression, the survival analysis, and the machine learning. Then they will use other statistical model variables like financial ratios, debt to equity ratio of the customer, interest coverage of the customer. These are standard analytic, right? Payment history. These are more down to earth. How are they paying? On time, delayed, interest delay, or what? Paid eventually. Now, those are payment history. Industry sector factors, right? Depends on industry. Different industries have different economic situations, different economic considerations, right? Different sectors have different. One size does not fit all. So manufacturing may have its own peculiarities, right? Primary industries, like if you're doing palm oil, you might have a different set of factors. And if you're doing some other industry like oil and gas or aluminum industries or something, you have different iron, manufacturing of iron, steel sheets and things like that. So all those have different sector, this thing. So what that sector depends on, all right? What that sector depends. So if you are in the brick sector, manufacturing bricks, so it depends a lot on construction. It depends on the economic environment. If there's a lot of infrastructure being done, a lot of buildings coming up, then there's a lot of money being pumped into the economy and makes the bricks industry very buoyant, which means that you will be looking at statistics in that point of view. But if the money is getting tighter, let's say if Bank Negara decides that too much money is flowing into the economy and causing inflation, and they increase the interest rate, restricting money outflow, and that will constrict the amount of demand for all of these industries. Maybe construction may slow down, and as a result of which, contractors may begin to pay slowly. So these are the industry sector factors that you need to understand, right? Now, you don't think of all this when you do a normal kind of incurred loss. Then you also look at market-based measure, credit spread on bond prices. What is the spread of the credit, all right, on the bond prices? And then credit default swap, the CDS premium. If you have a default swap, if you have a swap, all right, what is the premium on that swap, which the banker will charge for the hedging of that swap, right? Now, let's look at a practical example here. All these words are very complicated. Let's look at practical example of the probability of default in an expected credit loss calculation. Now, take a simple scenario of a corporate loan given to a company called XYZ Bahad. All right. So this is the year in which they gave the credit rating. The bank has accorded the 12-month probability of default and the lifetime probability of default. Okay. So let's take initially they gave the loan in 2024. The credit rating was then BBB, big B. So the bank rated the 12-month probability of default, this is the judgment, at 0.5. They also rated the lifetime probability of default to be 2.5% of the loan, right? Now, that was when they first gave the loan last year. Now, this year they have re-rated it. The credit rating is now dropped to BB, from triple B to double B. The 12-month probability of loss has increased from 0.5 to 3%, a judgment here by the individual financial institution based on their prior records, based on their historical information of all the other clients. They would have got a certain rating structure. And let's say they took 3%. So because of the fall here, the lifetime expected credit loss or the lifetime probability of default has also gone up to 15% because of the fall in the credit rating. So let's look at the analysis here. The probability of default has increased from 0.5 to 3%, 0.5 to 3%. And that is a 6 times increase. Why? Because of the credit rating falling. This likely indicates a significant increase in the credit risk. A significant increase in the credit risk. Okay? To the bank, that's a significant increase. You're downgraded. So the loan moves from stage 1 to stage 2. Right? And the expected credit loss measurement changes from 12-month probability of default to the lifetime probability of default. So now we will look at this kind of probability of default rather than the previous year on this. So when we want to teach the students, use this kind of simple analogy. Think of the probability of default like forecasting the weather. Don't forget, we are forecasting now. So historical probability of default is like saying it rained 10% of the days last year. That is a fact, a probability of default based on historical. 10 days, 10% of the days last year, it rained. 365 days, 10% it rained. Now, current is like saying, based on the current cloud conditions, there is a 30% chance of rain today. All right, last year was that. Today, there's a 30% chance of rain. Then forward looking, this is the 12-month expected. So forward looking, it's like saying, with the monsoon season coming, economy is changing, rain probability will increase to 60% next month. And this is the forward looking probability of default. 60%, 40% is what you can recover. Right? A very simple analogy, how you take the historical, current, and the future. Right? And then common questions that you normally get. Can the probability of default be 0? Customer is very good. Why can't it be 0? Or why can't it be 100%? He will never pay. Now, it will rarely be 0. Even a triple A rated entity, there is a default risk, not because they want to default. The economic environment in which they operate is sometimes very uncertain. It's not always given as 100% certain. All right, many things will happen. They have their own business, they have their own debtors. Their debtors may default, and therefore that will cause the effect, even though industry is good. So there will always be a default rate, never will be a 0. Right? So why can't it be 100? 100 means certainly, cannot collect already. It's a bad debt. Credit impaired. You don't call it bad debts first, you call it credit impaired. So I will write it off. I'll put a 12-month expected credit loss because it's still not yet collectible. But I know I cannot collect. I won't put bad debts. The word bad debts means is incurred, but here is expected to be incurred. So the correct word is a credit impaired, right? Credit has been impaired. Now, what about the probability of default for small company where you got no rating? Use a proxy setting. That means use similar company, compare with similar companies. Now, this is what auditors will do. If you are having this kind of situation, your auditors have done a lot of companies. They would have looked at similar industry. What would be the possibility of default, the probability of default in that kind of industry? All right, internal scoring models. Not all businesses will have internal scoring, like what is your rating? Industry average default rate. This is the wider perspective, all right, within the manufacturing industry debtors. What is the default rate for plastics industry? What is the default rate for something else? Because plastics may be PVC pipes. They are giving the construction industry. If the construction industry is booming, things will be better. If the construction industry is not booming, things may not be good. Now, even if the construction industry is booming, not every contractor is making money. Some may not be able to collect the money. Then there is the probability of default. That's why it can never be zero. You have to look at a very big picture. Teach the students how to look at the big picture, because this is a principle in the standard. It is not a 1 + 1 = 2. It is a principle that needs to be applied in real life. So when you expand their mind, to think in a wider perspective, they can see a better picture and how this fits into the scheme of things, rather than, oh, debit, credit, how much, how you debit, credit, no. All right. Then do we use the same probability of default for all loans to one borrower? Generally, yes, because it's one borrower. But you need to have another factor. All loans are also given on the basis of what collateral a bank or a financial institution can get. They are not going to get something without the financial collateral. So that will be considered. And then different seniority, right? And different terms. So a lot of things here need to consider. We were on this particular concept of the probability of default, and I was talking about some common questions that are normally asked. And I said we went through can the probability of default be 0 or 100%? We said it will never be 0. There will always be a default risk. 100% means it's certain default. That means really bad debts. But it's a potential bad debt, not a current bad debt yet. So what about the probability of default for small company? Internal ratings, internal scoring models, industry average rates. And do we use the same probability of default for all loans to one borrower? Yes, you will normally do that for one borrower, the same probability of default. But again, depends on collateral, which we will be coming to later. All right? Different seniority. What do you mean by seniority? Loan seniority means the first charge is the senior loan. If there's a subsidiary charge, then that is the secondary loan. So the seniority is the first loan, right? So look at seniority in that respect. When the bankers talk about seniority of the loan, is the first charge loan. So second, third, and fourth charges are the subsequent loans, subsequent charges. And then there could be different terms, all right, for different loans. So one borrower may have two different facility, two different terms. So that must be considered as well. Now let's look at a simple case study of the probability of default estimation, all right? So let's look at this case. A retail bank's credit card portfolio, all right? Bankers giving out credit cards, a retail banking, and the historical default rate from their records has been 2.5%. All right, there will be a 2.5% default rate. Now, then they look at the current economic forecast, expecting a recession. Let's assume that, expecting a recession. So the statistical records information also show there is a possibility of unemployment rising from 3% to 5% moving forward because of the recession unemployment will rise. And then the bank's internal model, each bank will have their own internal model, suggests that the probability of default from their past experience normally increases 1.5 times during recession, because recession is expected. So based on their internal model over the years, they have documented that the probability of default increases 1.5 times. So what then would be a reasonable forward-looking a possibility of default estimate? What will be in the light of this information? So let's look at that. They have a base default rate of 2.5%. So we take the base probability of default 2.5. Now there's a recession coming on. So adjusted for recession, all right, 2.5 times the suggests that the the probability of default increases 1.5 times during recession, right? So their base is 2.5, increase 1.5 times during recession, it comes up to a 3.75% probability of default. Now, there's another possibility here, rising unemployment. That might contribute to a certain extent because credit card, a lot of individuals also have it. So you don't know how much. So plus consideration of rising employment, increase the probability of default from 3.5 to about 4 or maybe even 5%. A forward-looking probability of default now. Recession is coming. Unemployment is rising. As of now, recession is not here yet. Unemployment has not started to rise yet. But we want to provide for that future. The probability of default, as of now, these figures will change as the years go by. So based on this, the probability will be 4% or 4.5 or 5%, depending on how prudent the bank is and what sort of credit card portfolio they have. A lot to business people, a lot to employee earnings, or what, because different structures have different payment methods. As an employee, of course, if he loses his job, he will find it difficult to pay the credit card. He will start looking for a way. So that is another possibility of default. All right. Now, another concept we got to understand is closely related to this is a concept called, it's not a concept, it's a fact. All right. It's not a concept. It's actually something important to consider for expected credit loss. Now, loss given default, LGD. This is a term, loss given default. What do you mean by loss given default? So loss given default means the proportion of the exposure of the loan that will not be recovered if a default occurs. Simple language, you give a loan 100,000, 30,000 langsung you cannot collect back. So that 30,000 is called the loss given default. And that is the proportion of your exposure of 100,000 loan that will not be recovered if a default occurs. You may be able to recover in between, but that 30,000 you cannot recover. That is called the loss given default. Every bank, financial institution will have a percentage, all right? It is variable between banks because of various factors. So a loss given default is 1 minus a recovery rate. Don't worry, I'm going to put that into figures. All right, just understand this. 1 minus what is the recovery rate? So the loss given default is the loss amount, all right, divided by the exposure at default. How much are you exposed? Okay, let's try to put some figures after this. So the key components of the loss given default, right? Exposure at default, the total amount owed at the time of default. That means 100,000 plus interest. Let's say interest is 5%. Let's put a simple figure, 5%. All right, 105,000 is the amount at the time of default. is being owing 105,000. The recovery, amount recovered through collateral, because there's a collateral on the loan, or there could be a personal guarantee or legal actions, whatever, you can recover a certain amount. So you must consider recovery. What is the cost of the recovery must also be considered. If you want to recover through legal action, there could be legal costs, there could be administrative costs. You want to sell the collateral, there will be selling costs. So there will be recovery costs. And the time value of money, you will not recover now. You have to go through the process. So it may happen later. So you need to discount it to the present value. Right? Complicating? Not really. Let's look at the example. How the loss given, how the LGD or the loss given default is obtained or estimated. So loss given default can be derived using different approaches. So let's take number one, a historical approach. Use historical information on default and recovery. So a formula, something like this, loss given default, total loss from all the defaults, total expected exposure at default, total exposure at default for defaulted assets. Now, if the historical data shows that on the defaulted loans of 10 million, the bank recovered 6 million net of costs, then the loss given default is 40%. 10 million, you recovered 6 million, 40% cannot recover. Loss given default. In the language of olden days, this is bad debts, expected bad debts. All right? No such thing as expected bad debt, but I'm creating this word here. So this is if you have no collateral. What happens if you have a collateral, right? Estimate recovery based on collateral value. So the formula is like this. The loss given default is equal to the exposure at default minus the collateral you're holding, so it'll be reduced, divided by exposure at default. All right? So adjusted for collateral volatility. Collateral also can go up and down. Haircuts, you give a haircut on the interest, and maybe liquidation costs as well. So that will be a second approach, collateral. First one, historical, based on historical. Second one, based on your collateral. Third one, based on market-based. Means what? Market prices of default debt instrument. Investment in a bond is a debt instrument. All right? So say 6% bond or 7% or 8% bond. So market prices of the defaulted debt instrument. If a bond trades at 30 cents on the dollar or the ringgit after default, the market implied loss given default is 70 cents. Trading at 30, 70 cents cannot recover. So 70 cents will be the loss given default on this market-based approach. It will change from time to time. Now, the fourth method is model-based approach, using a model. Use a statistical model. Either you use regression or, as I mentioned just now, machine learning, artificial intelligence. Today, they are using these things based on historical and model and incorporating the borrower's characteristics. What is the characteristics of borrower? What business is he in? How is his payment mode? All right. How is frequent? When is his business up? When is his business down? All right. When is peak seasons of the year? When is non-peak season? So these are characteristics of the borrower. You can feed in all this. With AI today, they can also help to calculate. Then the collateral that you have at the end of the day. What is the collateral? A property? Gold? Whatever. And what's the value? Value may change. What is the economic conditions? Right? So economic conditions will also affect collateral. And then what about the industry or the sector in which they're operating? Information on the industry. That's called a model-based. So all these we just need to teach them that there are these different four methods. All right. The loss given default, the expected bad debts, right? Totally bad. Using historical approach, using collateral-based approach, to be using market-based and model-based, right? Now, let's take a practical example of calculating the loss given default. Let's say this financial institution has given a loan of 500,000 ringgit, all right? Collateral property valued at 400,000. Expected recovery costs if they were to institute any legal action or sell the collateral, that recovery cost is going to be 20%. Now, if you go back to earlier, I did say that, all right, the formula will be estimate recovery based on collateral value, adjust for collateral volatility, haircuts, and liquidation costs. So here is where we are looking at that situation here. Sorry. All right, I overshot. All right. So collateral property value 400,000, loan 500,000, recovery cost 20,000. Time to sell the collateral. Let's say it takes a year. So 1 year, let's say the interest rate is 5%. So use a discounting of 5%. So let's do a step-by-step calculation here. What is the exposure if you default? The full amount is the exposure at default. That means he didn't pay. So you're going to take legal action. How much is the amount owing? 500,000. What is the collateral value that we have in our hands? 400,000. So what is the net recovery? Because you want to sell the collateral, you got to pay the 20,000. So 400,000 minus 20,000, what we can recover is 380,000. So 380,000 1 year later. So what is the present value of the recovery discounted at 1 year? 380 divided by 1 plus 1, 0.05%, right? Because the interest is 5. So you will get a value of, you can do a present value on the spreadsheet as well. You'll get 361,905. So we will never recover the full 380 because only 1 year later. So for now, the value that we are talking about is 361,905. So what is the loss amount then? So the loss amount is 500,000 is the full amount minus what you can recover, 361,905 at the present value. The actual one you're going to recover eventually is 380, but present value is 361. So the amount of the loss will be 138,095. Right? What is the loss given default? 138,095 divided by what you expect to lose, right? So this is the amount that you have, exposure at default, 500,000, because that's the full loan amount. So 500,000, right? 138 divided by 500,000. So the loss given default is 27.62%. In other words, the loss given default is 27.62. The recovery rate of the loan plus the collateral plus the 1 year factor is 72.38%. That's how we do the expected credit loss, right? So it has to bring in all these things. Now, what will affect this loss given default? Factors that affect the loss given default. This one. Number one, collateral quality and value. So we know that collateral here played a great part. 400,000 recovery, sell 380 discounted. So collateral value plays a very important part. So therefore, collateral quality and value. Higher collateral, that means you get lower loss given default because you can get back more money by selling. But if it's a lower collateral, then you give a higher loss given default. It may come to 30%, 40%, because your collateral cannot sell. Also depend on economic situation. But bankers will also consider, if there's a possibility of collateral going up, they will try to hold and release it on the right timing so they don't lose much, right? Sometimes they get this property people to lay long the house at a higher price or whatever price, because the market price is very much higher. They just want to cover back as much of their loan as possible. So seniority of claim, senior debt. Remember, first charge is a senior debt, second is a secondary, third, fourth is all these are lower. So these are subordinated debts. Senior, subordinated debt. First charge, senior, subordinated is second charge, subordinated to the second charge is the third charge and fourth charge. Some companies have several charges, all right? But the senior debt, the top one, lower loss given default than subordinated, because the first one will take out everything. The balance goes to the second one. So it depends on your charge. So subordinated charge will have a higher loss given default, whereas the main one will have a lower loss given default, right? Then you also talk about guarantee or credit enhancement. In addition to your collateral, you might have a personal guarantee from a director. So what the bank cannot get from selling the collateral, they may then move on to the personal guarantee of the director and try to get money from there. So that will reduce the loss given default. Remember, bankers and financial institutions are always very careful, because they don't only rely on the collateral alone, because they know that if your collateral cannot beat, they will go to the director, because the director is the one running the business. Of course, if the director does not put any property in his name, he may not be affected. But if he has got properties in his name, then it could be also. So it all depends on how the guarantee or the credit enhancements are. And then you have economic conditions. If there is a recession, common sense will tell you lower recovery value, all right, cannot recover. When there's a lower recovery, loss given default becomes higher. When there's higher recovery value, loss given default becomes lower. So understand that principle between loan and the collateral and the quality of the collateral as well, and economic conditions. So you see, one size doesn't fit all. There are plenty of things here. Industry, some industry like specialized machinery. If you're in an industry and you're charging the machinery for your loan, that machinery may be very specialized for that industry. Not easy to sell because not many companies are in that industry. It could be a very high cost to get into the industry. So if you cannot sell, then you're selling at a very, very, very cheap price. And that will bring your loss given default much, much higher. All right. So the legal environment, efficient legal system. If the legal system is such that it drags and drags and drags, then your time value of money is going to go up. You are losing more because you only get your money after 3 or 4 years. In the meanwhile, that money that should have been with you, you can't use it. So it becomes a loss. So again, it brings a lower, loss given default, right? Faster recovery, lower. Slower recovery, higher. Now, more important is understand the logic for this. So the expected credit loss now that we were talking about in our slide, using the loss given default, okay? So expected credit loss is the possibility, or rather the probability of default times the loss given default times the exposure at default. All right, exposure at default. Now, I want to go back to the exposure at default in case we overlook what it is. These are all very important terms to understand. All right. Let me go back to the term. All right. Now, what is exposure at default? The total amount owed at the time of default. which includes the principal plus the accrued interest. The fellow cannot pay. This is the total at this point in time. Then the recovery is what we saw, recovered by collateral, if there's personal guarantee, etc., and legal action. Recovery costs, how much you need to pay. We saw the example, right? Time value of money. When are we going to actually recover the money? You need to do the time value of money. So it depends on the legal system. If it is very fast, then your recovery is faster, then your loss given default is lower, right? If it's going to take a lot of time, your loss given default is going to be higher. Okay, so that is the critical approach to all of this. Right now, let me go into this now. So the expected credit loss using LGD, discount to present value using the original expected, the original interest rate, right? So example, the probability of default is 12 months, right? Probably a default 2%, 12 months. They have put a structure in their company for all the loan creditors. Anyone default, there is a possibility or probably is 2%. That's their own matrix, the bank's own matrix, all right? 2%. Loss given default, 40%, right? Then also the exposure at default, 1 million. So undiscounted expected credit loss, if you didn't discount, you have the 2%, 0.2, times the 40%, 0.4, times the 1 million. So the undiscounted expected credit loss is, I missed out zeros here, I think, because this is 1 million. So here we are talking about 248,000 to be 8,000. Is 8,000? Something, yeah, 8,000. Okay. So the discounted expected credit loss, if the default in 1 year, discount the 8,000.1.05, 7619, right? So that's how we get this defaulted, the loss given default, using all the information given to us. So at the end of the day, how much is the amount that you need to provide? 7619 on this default, all right? Because the default is only 2%. Probably a default is 2%. We are not talking about the whole 1 million. So the probably a default 2 million and the loss given default 40%, 1 million is 8,000. So if default occurs in 1 year, 5%. If all 2 years, then you go to 2 years, 3 years, and then this figure will go lower and lower. Your loss is higher, right? So let's look at it from the point of view of what we need to teach. The loss given default is never a constant figure. It will always vary by the product type. What is the product? Product here is whether it's a mortgage versus unsecured loan. Which you think is which is better? Obviously, a mortgage with a collateral versus unsecured with no collateral. Then, of course, the loss given default depends on the type of collateral. Sometimes you can recover better. Sometimes the bank takes a particular property, cannot sell. I know of some properties where the bank given a loan, somehow or other the customer defaulted, and then the default could not be so the collateral was there, but for some reason or other, nobody wanted to buy the property because it was situated in an odd situation where some people say, bad feng shui and things like that. So until today, more than 10 years on, the property still remains like that, right? And it cannot be sold. There's always the sign for sale, for sale, for sale. Many of the agents have tried to sell, but until today, it is not sold. So here again, that will probably be a very, very, very high loss given default. They probably cannot even recover. Okay. And I believe that the owner also became a bankrupt at the end. I know about this property because it's not very far from my house. And sometimes when I pass certain roads, I pass this house every time for sale, for sale, for sale. Last 10 years still for sale. Then when I went and inquired a little bit more further, and then I also asked one of my banker friends, I say, yeah, that one cannot sell. Somehow cannot sell. All right. So anyway, next one is the borrower segment. What segment is the borrower from? What industry? Certain industries, if they collapse, you can't collect the money, and it's very, very bad. All right. Then the economic cycle is very important. The whole world and the whole economy goes on a cycle of up and down over a number of years. So you don't know which segment of the economic cycle. So when you want to calculate the loss given default in a bank or financial institution, you must be very current in your knowledge. You must be current in your knowledge. Obviously, if you're working in a financial institution, you will know what's happening because you're dealing with all the customers. You know what's happening. So that's when you apply this principle there. So the bank will have its own rates. All you need to know, you must understand what is loss given default. You may need to calculate as well. And that's where you will calculate for the bank. Now, coming back to the standard MFRS 9. Loss given default should reflect current condition and reasonable forecast. Current and forecast. It must consider collateral and enforcement costs. You want to enforce the collateral. You want to foreclose on the property. You want to make sure that the thing goes to court. So all these are enforcement of the payment of the loan, right? And you don't know when you will recover the collateral. You need to discount it to present value. Those are the MFRS 9 requirements with respect to ECL, expected credit loss. Now, having said that, the next thing is challenges. Sometimes it's difficult to get historical data. All right. But nowadays, I think banks have all of them, financial institutions. But if you're any other organization, you might have a lack of historical data. Estimating the recovery timeline. When can you get the money back? If you're going to sell your collateral, when? Depends, as you remember, on legal timing. Sometimes court will say, okay, we have heard this case. The case will come up for hearing next year, March. My God, now it's January, next year, March. Then it comes in next year, March, it will come for something else in October of the next year. October the next year, okay, then we will hear the case in full court in the following year. So it drags on and on. All right. Now, this is where you're talking about, the time value, recovery timeline, and then incorporate forward-looking information. So the difference between the old historical method is we look at history, the record of default. Here we look at something we don't know, forward-looking, and that is a high level of judgment. Now, that high level of judgment must be backed by all of this information that you know. You need to find out. You need to do a research. Whoever is sitting at the bank doing this kind of thing will have to do all of them. The bank will have the historical, but historical is still historical. You need to know now. So that's where the ECL that we see in the standard is very easily explained. But in practice, there are a lot of things that need to go in. And the student must know this in principle. All right. They don't need to go into the detailed calculation. At least they must know example how it works. Right. Now, if you're talking about simplified approach for trade receivable, remember, for normal companies, they use a fixed loss given default percentage based on historical loss rate. So if the historical loss rate is 2%, then the loss given default is 2%. All right, they use historical loss rate. So this is very simple. Now let's look at another example. Calculate the loss given default for an unsecured. Just now it was a secured loan. Now we are looking at unsecured corporate loan with the following information. All right. So exposure at default is 200,000. That means that's the full loan. Historical recovery rate for similar loans that go into default with no security is only about 30% from the bank's own records or the financial institution's own record. Historical recovery rate for similar loan is 30%. This information is from the bank. The recovery costs going through the legal process, all of that mumbo jumbo is 5% of the recovered amount, right? We put at 5% recovered. So the average recovery period from beginning right to the end where you get your cash in the bank is about 2 years. Let's say for this example, the discount rate or the interest rate is 6%. So what will be the loss given default for this unsecured corporate loan? So let's look at this. The gross recovery is 30%. You can only base on your historical value. Now, this is only based on historical. Maybe in real life, that particular loan can have a recovery of 40%, 50%, maybe 60%. But you don't know at this point in time. You need a base. So the base is the bank's historical record. Historical recovery rate is 30%. All right. Then the recovery cost is 5%, as you know. So the net recovery, that's 30% of 200,000. All right. So this is the total 200,000. The exposure at default is 200,000. 30%, you can get only 60,000, assuming that the 30%. Net recovery is 60,000. One minus, this is the recovery cost. So 5%, so minus that, you get 57,000. All right, 3,000 goes for recovery costs. Now, the present value of the recovery, this is if you get the money now, but you are not getting the money now. You are getting the money over 2 years, and the interest rate is 6%. So the present value of the recovery of 557,000 divided by 1.06%, as 1.06 to the power of 2 years, right? So you can use an Excel spreadsheet, you can get this also. You can use a calculator, you can get this. So you get 50,748. Instead of 57,000, if 2 years time value of money is 50,700. So what is the loss that you actually incur? The total exposure at default is 200,000 minus what you can recover present value. So the loss will be 149,252. That is the absolute ringgit value you will lose. But what is the loss given default rate? So the loss given default rate will be 149,000, all right, which you're actually going to lose, and divided by 200,000, which is the exposure at default, you get 74.63%. So this is the loss given default for an unsecured corporate loan of 200,000, all right, and cannot recover, no collateral whatsoever, all right. So important point to note, the loss given default is a critical input. Small changes, all right, as you can see here, any change in one of these will affect this. We calculated earlier with the collateral also the same thing. So many variables depending on the collateral value, depending on how long you can recover, the legal process. That also makes a lot of difference here, all right? So small changes affects the expected credit loss. Judgment is required when data is limited. So if you can't get data, judgment. Where do you get the judgment? You cannot judge out of the blue. All right. You need to judge based on information that you are going to gather. Economic data, industry data. All these are important for you to gather. If you have collateral, what will be the expected value of the collateral? Market price does not always translate to the actual recovery price. Because when you recover, you always see, last time along the road, lelong, whatnot. So when people see it is lelong or bank is selling, obviously, the price will be lower. Bank is recovering what they want. They are not interested in the market value. They want to recover as much as they can to cover their loan. So if you can offer that right price, then that figure will be the amount. So sometimes people know, yeah, they don't bank sell one, not nice la, bad luck la, I don't want to buy la. So that can also push down the price. So sometimes people say, I managed to buy this lelong house at a much lower price. Now, that is the recovery that the bank gets. So it's a lot of judgment. Some will be very good, some will be not so good. All depends on the thing. So again, judgment is required. Documentation is the key. You must document each factor, how you get the loss given default. And then this is not a one-off working. When you got all the data, usually on your spreadsheets or whatnot, or you have a proper program that, banks usually have their own program, right, which will calculate based on that. You need to adjust the percentages. So regular reassessment. The loss given default is not static. It is something that is very live and moving. So you have to be updating when conditions change. Say economic situation is recovering, then the condition of the loss given default may be also better, right? Your loss may be less. So we don't know. So all these are the things that you use for the purpose of calculating that. All right. So all right. Okay. So any questions you can ask me? All right. Okay, I will proceed with this slide that I was working on. And I said that, this is the formula for the expected credit loss. So when you're looking at the expected credit loss, you are looking at actually the probability of a default, because expected credit, what do you mean by expected? You need to have certain formula for this. And the formula is the probability of default. That probability is an estimate. And then loss given default is the amount that you are going to lose, and what is the total loan. Loss given will be like total bad debts written off. Probability is a percentage. Exposure at default is what's your total loan, right? And so this is where we did, and we calculated, and we came up. So we need to consider the unbiased probability weighted outcome. Unbiased probability weighted. Now this is probably, as I mentioned, you don't need to go into the probability weighted, because that becomes a very complicated calculation. And usually financial institutions will have their own basis of adding a weighting to the probability. All right, adding a weighting to the probability. I can give you an example, maybe later if there is time, because that's another long story to explain on the probability weighting. But you don't need to actually explain all this, because not likely that this kind of things will be ever tested on, because it's too complicated. All right, it is more on practical side. But this part, yes. All right, time value of money, everyone knows about it. Reasonable and supportable forward-looking information, we covered that just now. What is reasonable? What is supportable? All right. So the practical application, you have to identify the portfolio or similar financial instruments, whatever is the grouping, whether it's going to be, loans, credit cards, whatever. Assess the credit risk changes. All right, the credit risk changes that happen, that you need to understand, and then measure the expected credit loss, 12 a month, or lifetime expected credit loss. All right, that is the whole loss that you expect to earn, that you expect to incur. Recognize the loss allowance in the P&L, either other comprehensive income for those which are fair value through other comprehensive income, otherwise in the P&L. All right. Update at each reporting date, depending on whether your reporting date is quarterly, half yearly, or yearly, right? So that's the practical application. So let's study another loan here. ECL calculation for a corporate loan. ABC Bank, it gives a term loan to XYZ. All right, initial recognition of the term loan, 1st January 24. Reporting date is 31st December. And then the loan detail is 1 million. Interest rate 5% payable annually. Term is 5 years. right? So they amortize the amount over the years because this is a term loan, all right? Now, the credit risk information on this loan, you're going to calculate the expected credit loss. External credit rating downgraded from triple B to double B. The debt is past due 45 days on interest payment. Interest alone is supposed to be paid on time. The interest is now delayed. It has passed that payment. Economic forecast indicates rising default rates in the sector. Economic forecast. If you read the Bank Negara or you read the current economic news on the Edge or something like that, all right, you will be able to get some very informative information on default rates. Probability of default over the next 12 months is 3%. All right, probability of default. Lifetime probability of default is 15%. This is given to you based on credit risk. A bank is going to give you. Loss given default is 40%. All right. That means to say 40% is going to be really bad. Discount rate, original effective interest rate, 5%. Okay. So what we need to do now is to consider, right? To consider the stage, determine the stage for this expected credit loss for corporate loan. Has there been a significant increase in the credit risk since initial recognition? What's the answer? Yes, because we said that, all right? The probably is defaulting, is rising. So there has been an increase in this credit risk, SICR, significant increase in credit risk. Yes, due to rating downgrade, which we also saw here, rated has been downgraded, uh, greater than 30 days. This is a rebuttable presumption, which has not been rebutted. Rebuttable means why has it been downgraded? All right, maybe it's been downgraded, but this particular loan doesn't fall in that category. It can be rebutted, but it is not rebutted here. So therefore, rating has gone down. So that is the stage. So it becomes a stage 2, lifetime expected credit loss required. Why? Significant increase in credit risk. Remember, when there is a no significant increase in credit risk, then it is stage 1. And when there is a significant increase in credit risk, it goes to stage 2. Stage 2 means you need to make a lifetime expected credit loss is required. Then calculate the expected credit loss. Now, the bank has given the expected lifetime probability of default is 15%, all right, calculated already by the bank. So you apply the lifetime probability of default, the loss given default, really bad, is 40%. The total loan called the exposure at default is 1 million. Make it very simple. I didn't put all the accrued interest. So expected credit loss before discounting, expected is 15% times the loss given default times the 1 million. So your expected credit loss on this is 60,000 ringgit of the 1 million loan, right? So discount this to the present value, assuming the default occurs in mid-year. We usually take 1 year, right? Let's say mid-year. So the present value of the expected credit loss is 60,000 times 5%, which is the interest rate, I think given here. I think I've given, 5%, right? Discount rate. And half year. So it's 58,536. So how much loss, expected credit loss would you give for this particular company? 58,536 is your provision for loss. So the journal entry will be debit impairment loss, right? You call it impairment also can. You can expected credit loss also can. And credit loss allowance. This will answer your earlier question. All right, is impairment expected? I like to also call it expected credit loss or impairment loss, 58,000. Loss allowance, 58,000. All right. because this is the current. Now, interest revenue recognition, stage 2. So interest revenue, this is 5% interest, right? So if you have stage 1, you take the full interest. Stage 2, what do? Gross carrying amount, 1 million, 5%, 50,000. Recognize the whole 50,000 despite the loss allowance. Because stage 2, you take up the full interest. Only on stage 3 do you do you take out the interest on whatever loss allowance. Stage 1 and stage 2, even though you created a loss allowance, expected credit loss, you will be actually given, you will be taking the full interest rate. But stage 3, you will not be. The question is, in exam, I presume that the OER will be given. Yes, it will be given because this becomes an individual bank thing. So you will not be able to get that, the expected thing. So you will be given. Yes, I agree with you. And then moving down, right? This is at stage 2. Stage 3 only you do. So discussion point. How will the calculation differ if the loan was in stage 1? All right. What if the loan becomes credit impaired on stage 3? Then the full interest cannot be taken up. How to incorporate forward-looking information, economic scenario? What disclosure required under MFRS 7? So I've given you some of the answers here, a suggested way of doing it. This is only a suggested solution. So let's look at this. How would the calculation differ if the loan was in stage 1? First, there is no SICR, which is significant increase in credit risk since initial recognition. That's why it is stage 1. Now, ECL measurement, expected credit loss, 12-month expected credit loss only, because no significant risk. Interest revenue, calculated on gross carrying amount. Don't adjust for expected credit loss. The gross carrying amount, you take it, right? Now, comparisons table, let's take stage 1 versus stage 2 from the case study. Now, the probability of default was a 12-month probability, 3%. The lifetime probability of default in the example is 15%, right? From our case. So time horizon, next 12 months only. The loan is 4 years. If you're talking about stage 2, the remaining life, 4 more years. This is only the next 12 months, stage 1. But stage 2, the remaining 4 years. So what is the expected credit loss formula? This is where we have to go back to our earlier, what we have studied on the probability of default, the loss given default, and the exposure at default. So we have to take the probability of default in the next 12 months times the loss given default, which you need to calculate, times the expected exposure at default. This is for the next 12 months. But stage 2, right, the probability of default becomes a lifetime probability of default times this one is only 12 months, this is lifetime. Look at the difference here. One is 12 months, one is lifetime, times the loss given default, times the exposure at default, the total loan. That's the ECL formula. So discounting, when are you going to recover it? So over expected default timing within 12 months, over expected remaining life, maybe several years to recover. So that discounting will follow the number of expected years to recover based on historical information available in the financial institution or the bank. Or it takes about 2 years to recover, 3 years to recover. So use that as the basis to do a discounting. The interest revenue in 12 months, you take the full interest revenue, right? So 1 million, and that is 50,000, 5% of 1 million. Interest you will take up. But stage 2, you also take up the amount. Only in stage 3, you don't take up this 50,000 interest income. All right? So that's how it goes there. Now, numerical comparison. If the loan remained in stage 1, 12-month probability of default is 3%. All right? Here, given earlier. Same as before, but only for the next 12 months. The loss given default is 40% because it's already given to us earlier up here, 40%, right? Somewhere here, Yes. Loss given default is 40%, right? So the exposure at default is 1 million, the full loan. So undiscounted expected credit loss, 3% is what we wanted to provide for. All right, 3%. I think it's somewhere further up here. Um, where is it? Yeah, probability of default over the next 12 months is 3%. So 3% is the probability of default already, the credit risk information given to us, right? They'll normally be given also. So therefore, you will have that this hang on, yeah. Right. Exposure at default 1 million. Before discounting, 15% times 40% is 60,000. Discount to present value, assuming this default, this already we have done. Sorry. I should be here. Yeah, sorry, here. Yeah, sorry. I missed the thing here. So undiscounted 3%, 40% is the loss given default. And this is a 1 million loan, which is the exposure at default, 12 million, right? So discounted, we now discounted in the next default in 6 months. So we take 12,000, which is this amount, 5% discounted over half year, 11,715. So this will be stage two from the case. You'll have expected credit loss 58536. All right. If you remain in stage one, it'll be that stage two from the case that we saw, 52536. Now, the point to note is that the expected credit loss is 5 times higher in stage two. Verse, this is 58,536, all right, which I calculated somewhere here. Yeah, 58,536, all right. This is the lifetime, 58,536. So here, the 58,536 in stage two is much higher than on stage one. Reason? Why? Because the lifetime probability of default, 15% versus the 12-month probability of default, which is 3%. All right. This is 3% for 12 months, lifetime 15%. So naturally, the expected credit loss on the lifetime is much higher than the 12-month expected credit loss. The longer time horizon for potential default, the longer the time horizon, the potential default is greater. So interest revenue is the same in both stages, stage one and stage two, because you take the 5% interest calculated on the gross amount, don't discount it for the loss. Stage one is about normal business risk. All right, in simple language, normal business risk. Stage two is elevated risk, requiring full lifetime provisioning of what cannot be estimated to be calculated. What cannot be estimated to be calculated in simple language? Stage one, normal business risk. There will be a certain amount of default. But stage two is an elevated risk. Full-time provisioning is required, right? So if you look at numerical comparison, if the loan remained in stage one, right, the 12-month probability of default, which we saw just now, is 3%, same as before, but only for that 12 months. The loss given default is 40%. The exposure at default, the full loan, is 1 million. So undiscounted will be 3% times the 40% times 1 million. So then this will be the undiscounted expected credit loss will be 12 if the loan remain in stage one. Just now we calculated in stage two, right? Hang on. Oh, sorry. I might have repeated the slide here. Sorry. Yeah. I think slide 28 repeated. Yeah, okay. Just ignore the slide 28. And we go on to slide number 29. 28, I inadvertently put in the slide again. My apologies for putting the slide. Please cancel it. So what if the loan becomes credit impaired, moves to stage 3? What will happen? Now, remember, this is our question here, right? What if the loan moves to stage 3, right? Point number 2 here. So here is where we are going to look at what if it moves to stage 3. So stage 3 trigger, objective evidence of impairment at the reporting date. Objective. That means he actually defaulted. That's objective. Okay. So he changes in stage 3. For the ECL measurement, you straight away go into lifetime measurement from stage 2. You go to lifetime, ECL may be higher than what was calculated at stage 2 because of the risk. Interest revenue on gross carrying amount you still take up. But here, you take only net of the loss allowance. Take out the loss allowance only on the amount that is not a loss allowance. Calculate the interest. Practical implication, warning signal. Still accruing full interest, but stage 2 is a warning signal. So there will be in normally banks and financial institutions, there'll be a very high focus on this stage 2, because normally, unless a person recovers or a company recovers, chances are it will go on to the next stage. Not to say it will never recover, but from practice, people who are good, they will be able to pay. But people who cannot pay will drag and drag. And that becomes a downward spiral for the business, which, if you are in the point of view of a bank or a financial institution, you will know this company is in difficulty. The money is not coming in. The interest is not coming in on time. If suddenly they begin to pay the interest, then you know they are recovering. But if they are not doing that, then you know very well the warning signal is there. Now, when there's a going to stage 3, it becomes an actual loss in event. You don't accrue the interest on the amount that you expect to lose. How many percent? All right. What is the amount of the loss that you expect? You don't accrue interest. So the accounting treatment you treat as an allowance. Here will be a direct reduction. Here is expected credit loss. Is an allowance. Here will be directly a loss that you're going to provide for. Right. So that is the difference between stage 2 and stage 3. Now, still continuing on, what if the loan becomes credit impaired? All right. Scenario extension from the case study. Assume that in year 2, 2025, because 2024 the loan was given, the borrower says, yeah, I can't pay. I file for bankruptcy. Then the recovery that you expect to get in the bankruptcy proceeding is only 30% of the loan. And you only expect to get it after 2 years. So legal cost of recovery, 5%. So the stage 3 calculation will be something like this. All right. So exposure is the full exposure of 1 million, principal plus the accrued interest. Let's assume it's included. Expected recovery is only 30%. And that also only after 2 years. Right. So you get 30% of 1,300,000. So what is the cost? 5% of recovery cost. So net recovery after cost will be 300,000 times 5% of the 300,000. Let's say it's 15,000. So you get 235 is the net recovery. And you are not going to get that money immediately. So when you are going to get that money, the present value of the recovery, which is 2 years, because you're going to get it only after 2 years, then discounted at 5% per annum, 285,000 divided by 1.05 over 2 years, you will get only 258,000. So how much do we provide for the lifetime expected credit loss? 1 million, which is the full loan, minus this present value of the recovery, 258,000. So our lifetime expected credit loss on this $1 million loan at a 1 million ringgit loan at stage 3, 745,497. totally bad. Right? So this is called lifetime expected credit loss. We still use the word expected because it's going to be, right? You have not reached the stage yet. You are now providing this year, when the loan this year has gone into stage three, this is what you cannot recover. Okay. So journal entry comparison on stage two, impairment is 58,536, loss allowance is so much. Interest is the full amount, 5%, 50,000, 50,000. Stage three, impairment loss, 62, which is actually 741,000. This is the full loss, minus what we already provided, 58,536. 741 minus 58,536. So the impairment loss that you need to put addition will be 682,961 and credit the loss allowance of 682,931. Interest now will not be the full 50,000. You will take only 5% of this minus this loss. All right. So the interest revenue will be based only on that balance, which is 12,925. Interest revenue, 12,000 as against 50,000. This you expect to recover. So your interest must also be taken up together. All right. So points to note from what we have just looked at. Interest revenue drops significantly from 50,000 to 12,925 from stage two to stage three. Right. Cumulative expected credit loss increases as default becomes certain. All right. The cumulative expected credit loss is going to increase because loss becomes more certain now on stage three. Stage three is about realized loss. You actually are realizing. Now, I put the word realized loss in inverted comma because you have not actually realized yet, but you expect to realize this. Stage two is you anticipate the loss, right? Anticipate. I think this is going to be the loss. But because of the circumstances here, when the borrower filed for bankruptcy, the whole circumstances change. Is no longer anticipated, is realized. So that's why bankers can track the way your payment is, and when you stop paying the interest and the thing starts to accumulate, you are in a dire straits. They will send you letters, legal letters, blah, 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 everything. So if you respond to it, then there is a hope. But when you cannot respond to it, knowing this is a dead case already. So that's where you call a realized loss, right? But if he gets money and pays back, the loss will not be there because he still got time. No doubt the loan will be cancelled, right? Once in stage three, you cannot go back to stage two, all right? Only to stage one if credit improves significantly. In other words, if you're on stage three, you cannot say, oh, I go back to stage two. Technically, you can't. If you want to move, that means you pay off your loan. All the outstanding balance you pay off. Then you go back to stage one. Right? You have to, because you cannot say, I pay half the amount, can go back to stage two. No. You're still in stage three. You're already considered bad. So again, these are the things that you need to know. So next one is on the next question, which is, let me go back to the question further. How to incorporate this number 3 on slide 23, how to incorporate forward-looking information like an economic scenario. And then we go on to number 4. What disclosure will be required under MFRS 7? So now we are looking at this. We have already looked at this too. So let's look at this. Right? How to incorporate forward-looking information. So what is the standards requirement under MFRS 9? You must consider reasonable and supportable information that is available without undue cost or effort. We talked about it this morning, all right, at the reporting date about past events, current condition, forecast of future economic events, all right? So practically, how do you do it? Multiple economic scenarios approach. This is what you do. Probability. What is the gross GDP growth? What is the unemployment rate? What will be the probability of default impact? So all these are things that you need to understand in theory. Because in the banks they will give you as all this the base case probability is 60%. GDP growth is plus 3%. Unemployment is 3.5%. So the impact is you'll probably have to work out this figure. Upside, if it's going upwards, probably is 20%. All right, the loss will be less, and GDP growth is increasing, unemployment is maintaining, and in fact is reduced, then this will go up by 0.8 times. This is one time. Downside, assuming this is the one base, this goes down and this goes further. Downside, 20% is the probability. The GDP growth is -2. Now it's going down. Unemployment has gone up. Now this is bad, right? So the impact will be 2.5 times. The probability or default will go up 2.5 times. All right. Here upside, it went down to 0.8%. Base case is 1, right? Upside gone down by 0.8. Downside went worse by 2.5 times, right? So this is how you incorporate. So applying this to our case study, the base rate, let's say the base probability of default current is 15%. That will be adjusted for the various scenarios. So base rate is 15%, right? So the weighting is 60%. Now upside, sorry, let me just clear my throat. All right. Now the base rate is 15%. The weight is 60% on this. Upside, what is the chance it will go upside? All right. So it's 15% times 0.8, 12%. So you give a weighting of 20% on this. All these are judgments. When it goes on the downside, right? So there's a 15% that will go down, 2.5, 37.5% that it will go downside, weighting of 20. So altogether is 100%. If your base weighting is 60, then it's 20 and 20. So you have to work this out, and therefore you will get the weighting. Now, what is the weighted? So these are all individual weights, right? Let's take the total weighted probability of default. 15 times 0.6, right? 12 times 0.2, this is 15 times 0.6, 60%. 12 times 0.2, 20%. 37 times 0.2. So the weighted probability of default will be 18.9%. This is called forward-looking information, which translates into a lot of nitty-gritty figures. Now, third one, revise ECL with forward-looking. The probability of default is 18.9%, all right? And then, which is versus 15% without forward-looking, because what is given is 15% base without forward-looking. With forward-looking has gone to 18.9. So the expected credit loss, 18.9 times 40%, all right, because 60% is already good, as you can see here, all right? The weight is 60%, so the 40% here. So 40% is the loss, 60% is the good. So 18.9 forward-looking percentage times 40% expected to be bad times 1,075,600 is the undiscounted expected credit loss. Then, of course, time value of money is 6 months. So 75,006 divided by the percentage discounted over 5% over half a year, 73,778. So now the ECL increases by 26%, 78,778 versus 558,000 that we calculated earlier, right? We calculated earlier the loss allowance of 58,000. Was that? Yeah, yeah. All right. 58,000. So from this is where you'll see that the figures move from increase it from 73,000 because it is now looking at forward-looking information, right? Now, point to note how to incorporate forward-looking information. It's not optional. Forward-looking information is mandatory under MFRS 9. It's not optional at all. Now we need to use macroeconomic variables. We are using all the macro. We are not going into micro relevant portfolio. Like you saw just now, we used the GDP growth in that example here, right? Where we took a few of the information and we looked at the GDP growth. Oops, where did I missed it? Probability, GDP growth, unemployment, and the probability of default impact. So this is where we are looking at this now, right? GDP growth, unemployment rates, property prices, mortgage because you need to sell, right? Commodity prices if you are using specific sectors. Do not over engineer. That means when you talk about without undue cost or effort, make sure it's without undue. Don't go into very great detail. All that is only done in real practice when the banks go into very great detail. But in real life, don't go into all that. Understand undue cost or effort. Okay. Quote it as undue cost or effort as the standard says. Now, document assumption, because in the bank's case, they want very much detail. So to them, it's not an issue of undue cost. They want numbers that are correct. Bank Negara is also going to go through it. So they want numbers that are very correct, as close as possible to the actual. So to them, it's not so much of undue cost, depending on the banks. All right. So document assumption. P for audit and compliance. So make sure you document everything, all the assumption, so that whenever the Bank Negara audit or external audit comes in, they're able to understand how you arrived at all of these figures, documented. So moving on, what disclosure will be required under MFRS 7? The fourth question. So disclosure category for credit risk, you will have quantitative, number one, and you will have qualitative disclosure, quantitative and qualitative. So that's why if you look at financial statements of all these financial institutions, you'll find a huge amount of disclosure on the risk area. So this is how you'll have to do it. Now they need to understand this. Know what are the quantitative disclosure? The students, I mean, the credit risk exposure by credit risk rating grades. Now, if the rating is AA, triple A, double A, double B, or less than double B, the stage one, right? The exposure 500,000, AA will be 800,000, BB will be 200,000, and BB will be zero. This is 1.5 million. Stage two, 500,000, zero, because there's no stage two, it's on stage one. So the total is 5.1. But stage two is 800,000. Part of it gone into stage two already. So no stage three, 900,000 amount outstanding is gone up. BB, double B, 200,000 is the credit exposure, right? Stage two moved on 300,000. And then move to stage three is 500,000. So the total is actually 550,000, right? This is the rating grade. You have to show that these are notes explaining in the notes and the accounts. And then less than BB, there will be no stage one, all bad already. So stage two is still 100,000, 150,000. So 250 on another portfolio. So the total of 1.5 million divided into the various categories. That is your loan portfolio. Triple A, double B, less than double B. And then this is stage one, stage two, and stage three. All right. So at the end of the day, your total credit exposure is 2.2 million. Okay. 2.2 million is what you need to show. Then you need to reconcile the loss allowance, another quantitative disclosure. Stage one, stage two, stage three, and total. Balance at the beginning of the year, all right, 10,000 or 10 million. So stage two is 30,000, Stage 3 is 50,000. So 90,000 is the balance at the beginning of the year. Now, moving to during the year, changes due to new assets, 5,000 in stage 1. Stage 2, these are new information. Stage 2 has gone to 2,000. And stage 3, none. So 7,000 is new assets came in, of which stage 1 and stage 2 have been classified as such 7,000 or 7 million, whatever. Transfer to stage 2, right? This 8 million has now moved to stage 2. So there's no more stage 1 here because the debt became bad. I'll move to stage 2, right? So then this will become 0. And then transfer to stage 3, 5,000 here has now been classified as stage 3, right? So write off 10,000 was really a bad debt, could not be recovered in stage 3, written off. Okay. Foreign exchange changes due to foreign exchange. This thing will be so much. Balance at 31st December, because international, you might have foreign exchange. Balance will be, of course, you bring down the figure here, 6.5, 34.5, 44, and the total is 85.5 from the beginning of the year to the end of the year. All right. Take into account all the movement within this. Right. And so, qualitative disclosure. What are qualitative? Inputs, assumptions, and techniques. So you have to explain how the probability of default, how the loss given default, how the exposure at default is determined. Notes on the accounts. Use of external ratings versus internal model. External rating, like Moody's and all that, versus internal model. What are you going to use? All right. Forward-looking information considered. What are the forward-looking information that you considered? You can list that down. Time horizon use, how long? Policies for determining the SICR, significant increase in credit risk. So criteria for moving between stage 1, stage 2, and stage 3, you will describe that. Use of 30 days past due presumption. So you presume that after 30 days, unless you can rebut that presumption, that means to say it is already becoming to the next stage. If you can rebut that presumption, it doesn't move from stage 1 to stage 2. It remains in stage 1. That's a rebuttable presumption. Then monitoring procedures. How do you monitor this debt? What are the collateral and the credit enhancement? Type of collateral held, because that's very important as well. Policy of how you value the collateral is a policy, and market value, etc. And information about credit risk mitigation. How do you mitigate your credit risk? These are qualitative disclosure that needs to be shown, right? So let me just finish one more line here. For our case study, right, loan, specific disclosure will include in the notes of the financial statements, credit risk and expected credit loss. The group assesses credit risk on corporate loans using 3-stage expected credit loss model. Significant increase in credit risk identified based on external credit rating downgrade. So you're basing on external, all right, Moody's and all of that. Past due status exceeding 30 days and adverse changes in economic condition, external. For the loan to XYZ, 1 million, a significant increase in credit risk was identified during the year due to a rating downgrade from BBB to BB and past due interest payment exceeding 30 days. Two things, downgraded and they also could not pay. Accordingly, the loan was transferred from stage 1 to stage 2, resulting in the recognition of a lifetime expected credit loss of 58,000. This specific to our example, all right? And that was the amount there. So key assumptions used, probability of default, you need to show this. That's why if you read the accounts, you'll find all this inside. 15% lifetime, loss given default 40%, discount rate, effective interest rate, economic scenarios considered base, upside, and the downside. This is a disclosure that is required under MFRS 7. Right? So this is, we are not actually going through the actual disclosure part of it, but this is part of this question. So I thought I would put it in here rather than splitting up into the other section on disclosure. So this is what we need to do as far as qualitative and quantitative disclosures are concerned. So based on our example just now, Note 10 or Note 5 or Note whatever it is. So credit risk and expected credit loss. So the group assesses, I've shortened it to make it simple. If you look at the banks and the financial institution, oh, they go really, really, really long. Okay. So the group assesses the credit risk on corporate loans using that three-stage expected credit loss model. Significant increases in credit risk are identified based on external credit rating. So they use one of the external rates, either the Moody's or S&P, etc. And the external credit downgrades, past due status. They also look at whether the debt is overdue, exceeding, let's say, 30 days, and whether there are any adverse changes in the economic conditions, because this is one of the principal things that you need to understand when expected credit losses do arise. Changes in the economic conditions can cause companies to face difficulty. So for the loan to XYZ Sendiri and Bahad of 1 million, there's a significant increase in the credit risk identified during the year. Why? Because of the rating downgrade of this particular company from BBB to BB and past due interest payment exceeding 30 days. So two things. The interest also was past due. Now that's a very sensitive thing, right? Past due is always sensitive when it comes to banks because they are watching your credit. If you are good, you'll pay on time, right? You are expected to pay on time. You are expected to plan your payment so that on that date, you don't miss the payment. All right, unless there are very extenuating circumstances that may have, caused you to miss the payment, but there must be a very good reason for that. And also, accordingly, the loan was transferred from stage 1 to stage 2, resulting in the recognition of lifetime expected credit loss of 58,000, not only the 12-month, but the lifetime, right? And then there were certain assumptions that were used for the credit risk and expected credit loss calculation. So this will be the probability of default. So the company had a fixed rate of about 15% lifetime. The loss given default in this particular case is 40%. The discount rate was the original 5% discount rate. Economic scenarios considered: base, upside, and the downside. Right? The base is the standard. What if it goes up? What if it goes down? Something like a sensitivity analysis, this one. Okay. So the risk concentration, where was the risk? So maximum exposure to credit risk. When you give out a loan, you give out a facility, you are exposed to the risk of not collecting it back. That's the credit risk. All right. And that's one of the concentration. The other one, geographical concentration. Depends on where you are located, where your business is located. Also, industry sector concentration. Are you in the manufacturing? Are you in the extractive industries? Are you in oil and gas? Are you in finance industry? Whatever it is, all right. So that industry is also important. Then the single counterparty concentration. So therefore, are you concentrating on single counterparties concentration or multiple parties together? Right? If you're a single party, higher risk. Multiple, the risk may be lower. May, right? And then a quick reference in the stage of comparison. Stage 1 means healthy. 12-month expected credit loss is normal. Interest taken up on gross. So basically, stage 1 is healthy. Stage 2 is a warning light coming on. All right, you're not bad, but you're warning. You could go bad, So that becomes a lifetime expected credit loss. But we still take the interest, as you know, on gross because it is not bad yet. It's just a warning light. When it comes to stage 3, it becomes impaired or expected credit loss. Lifetime interest on net. Don't take the amount of the full loan. Take out what you have impaired or what you have done, the expected credit loss. Interest is on the remaining amount only. All right? So risk concentration disclosure. So some of the points that we need to note in this area will be disclosure is just as important as recognition, because you must explain how you got your probability of default, how you have got the loss given default, and how do you have the exposure at the default. You need to have all this explanation. You must disclose, and that's transparency. Otherwise, you can hide behind numbers. So tell the story. Disclosures actually explain why the numbers come on, why all these things. All right, why all this? Why? All right. Then you need to put in the qualitative and the quantitative. Both are required. You need to also show comparative from last year, because one of the important thing is what happened last year and what's happening this year. It gives you a comparison. So you must show the prior period in changes. And then connect. That's why you have the reconciliation opening to the closing. Remember? Connect the MFRS 9 calculation to MFRS 7 disclosures. So MFRS 9 is all on the standard financial reporting, and 7 is on disclosures. So we have to link two together. They are not in a silo. They are all connected together. All right? So now I'm going to go back to the before we come to the disclosure, because the disclosure is not a very difficult topic. I just want to, never mind, I'll do the disclosure first. Then I'll go back, because I'm scared when I start changing towards the other notes, this thing might cause a problem and get hanged again. So we'll go on the disclosures, all right? This is MFRS 7. Now, we will do a quick revision on the expected credit losses a little bit afterwards, but we will do the disclosure first. So this MFRS 7 says that you must disclose information that enables the user of the financial statement to evaluate what is the significance of financial statements, all right, for its financial performance and financial position. So people must know how to evaluate. And that is what was very much lacking in the olden days, with even before 139. And when 139 came out, at that time it was good, but then as people moved on, as the market moved on, as stakeholders moved on, they wanted more information. They were not interested in just getting the very basic information. They wanted more. And that's how it evolved into MFRS 9, right? So what you need to show is significance of financial instrument to an entity's financial position and subsequent performance. How significant it is to your performance. Nature and extent of the risk that arises from the various financial instruments to which this entity could be exposed. You got to explain, all right, the nature of the risk and the extent of the risk, which is what we showed just now, during the period and end of the reporting period, and how you manage those risks. There are risks. How do you manage them? All right, provision for the stage 1, stage 2, etc. That's how you manage them. Now, risk management information basically influences what the user is reading. The user is going to assess the financial position and the performance of the entities that they are looking at. Right? Performance is, of course, balance, profit and loss account. But position is the balance sheet or statement of financial position. They are also going to look at the information relating to the amount, the timing, and the uncertainty of the future cash flow. This is about the most important part. Timing, uncertainty of the future cash flow, because this will determine whether the company will be able to earn its income normally, or is there going to be a write down? And that's important to understand. So people looking forward, remember I said today, the stakeholders are not only looking at historical, they are looking at current, and they are looking at forward. So current also includes fair values. Fair value is a current value. All right. So future this is one of them. The expected credit loss is in the future. Other things are like going concern, but I won't be covering that today because that's not in our itinerary today. All right. So therefore, the amount of timing, uncertainty, and the respective entity's future cash flow. Will the money come in? Most important. So MFRS 7 applies to all risks from all financial instruments. Only a very few limited exceptions. So the only exception you will see is the debtors, trade receivable, where you don't have to create a 12-month expected credit loss, but you will create the lifetime expected credit loss. It's not exempted from lifetime. It is about the lifetime, all right, for all kinds of trade receivable and also lease receivable. These are the only two exempted from 12 months expected credit loss. It applies to all entities, including those that have only a few basic financial instruments, like only accounts receivable and accounts payable. So in terms of accounts receivable is where we are talking about you need to disclose how much is receivable, whether there's any lifetime expected credit loss. So it is still calculated, but not the 12-month expected credit loss. Unless, of course, remember, you have given debtor a period of time to pay in excess of 1 year, maybe like 2 years. Then you have a time value of money that's factored in. Then in those cases, you must look at the 12-month expected credit loss and the lifetime expected credit loss, where you give, a credit facility more than 1 year. Because anything within 1 year, we don't calculate the time value of money. So it must be more than 1 year. So basically 2 years lah. We don't count 1 year, 1 month, 1 year, 2 months. That's not really the way finance is done in terms of short term. You're looking at the next year, right? About next year, 2 years. Now, the risks arising from financial instruments will be categorized as many, many types of risks. So I'll give you a few and then I'll go into more detail. Market risk. Financial instruments are subject to market risk. What is market risk? It does not imply merely the risk of loss, but the potential for gain, which in turn could include currency risk. Market risk depends on where you invest. If you invested overseas, then the currency risk is also overriding, or rather another factor there. And if you are borrowing from overseas, you're also not only looking at the risk of, loss, you're also, or lending overseas, interest rate risk, another price risk. It is a comprehensive summary of how future changes in business environment will impact our assets, not merely bookkeeping, debit, and credit. All right, if you give a loan to someone else outside of the country, or there's some funding on a project outside the country. So the question is, how is it going to be paid? In ringgit Malaysia or in US dollars or whatever currency? So there will be the currency risk, the interest rate risk, and price risk as well. If price risk is going to be something that is part and parcel of the loan given. All right. And then you have the currency risk, the financial loss that may be possible due to changes in exchange rates between currency. And this kind of things will affect entities that have assets and liabilities denominated in foreign currency. You may have bills, you may have receivables from foreign currency in US dollars. You may have been trading in US dollars. Your functional currency could be US dollars. You're buying in US dollars, selling in US dollars. So you have a payables in US dollars, you have a receivable in US dollars. So a receivable in US dollars, again, depends on the currency. As you know, our currency is strengthening against that, although the last 2 days has been a bit of a peak. But then that is what you call whether there's going to be a financial loss or gain due to exchange rate between the currency. It affects those entities that have liabilities denominated in foreign currency. You may be having foreign exchange cash in other banks. That will also be a financial instrument. You engage in import-export transactions, right? Operate subsidiaries in different countries. You may have a subsidiary in Indonesia. You may have a subsidiary in, Europe, or you may have a subsidiary in Thailand or wherever it is, or even Singapore, Australia. So all of them, you are dealing with different currencies, all right? So there will be a currency risk. And then you have investments in foreign markets. So you can invest anywhere. US dollars, you can invest on NASDAQ. So all of this will have a currency risk again. So what are the types of currency risks that we come across? So the type will be a transaction risk or a translation risk, which is end of the year or end of a period, or the economic risk. So let's examine, what do you mean by the various type of risk? Transaction, translation, and economic risk. So in a transaction risk, it is actually a risk from actual future cash flow in a foreign currency, whether or not, all right, you receive the amount that you expect to get, or you do receive, but because currency changes, the actual amount you receive could be less or maybe even more. All right, the risk of more is, of course, no problem. The risk of less is what is important. The amount is paid in full, but because of currency, you lose money. So, risk from actual future cash flow in foreign currency. Example, Malaysian company selling to a US customer. Receivable is in US dollars. So if US dollars is going to be, up or down vis-a-vis the Malaysian ringgit, then we will also have a gain or a loss vis-a-vis the Malaysian ringgit. And you cannot recover that loss. If it's a loss, gain, no problem. And then you have a translation risk, right? This is transaction. This is translation. Merely converting a foreign subsidiary financial statement into reporting currency. If you have a foreign subsidiary, every year end or every period end or every quarterly, if you are doing quarterly accounts, half yearly, you need to translate the foreign currency subsidiary into Malaysian ringgit for the purpose of consolidation. Now, there will be the translation difference. But this translation is not realized yet. All right, but there is a translation risk. So the risk from the converting or the conversion of foreign subsidiaries financial statement to the reporting currency, which is ringgit Malaysia. Now that will be the description. The example will be Maybank converting its Indonesian subsidiary financials into Malaysian ringgit. We all know Maybank has subsidiaries in London, it has subsidiaries in Indonesia, subsidiary in Singapore, and I think a few other countries. I believe Australia as well, because I remember seeing one. So all these subsidiaries, when they are consolidated, there will be a risk of translation, whether up or down. All right. And then there is the economic risk. And what is the economic risk? The risk of a long-term change in exchange rate affecting competitiveness. So long-term exchange, if you are having subsidiary in a country overseas, over time, currency may increase or decrease. Think of a long-term one. Malaysian ringgit was like something like what, 280 or 3 ringgit to the US dollar. It went to 4 ringgit and then went to 4 something. Then it coming back again. So this is what they call long-term changes in the exchange rate. Your subsidiary is still intact, but the long-term changes affect. If you have a long-term debt, then that long-term debt amount that you receive or pay was going to be also changing. That's also another economic risk. So Malaysian manufacturer losing price advantage if the Malaysian ringgit strengthened. So if our Malaysian ringgit is high, our exports are going to be expensive vis-a-vis the other currency. And if our Malaysian ringgit is down, we become cheaper and we can export more. And so we earn more foreign exchange. So these are economic risks, as you may understand it to be. So let's look at interest rate risk, right? The risk that the value of the instrument, whatever interest, will fluctuate due to changes in the market interest rate. Now, market interest rate is not fixed. All right, as we all know, borrowing costs go up and down depending on governments, depending on the funds in the bank, depending on the loanable funds theory, how much you can loan out, how much you cannot. So all of this will be, a standard fixed rate, plus banks will add on their whatever rate. So there is an interest rate risk that the value of the instrument will fluctuate due to changes in the market interest rate. And as we know, if the government wants to bring money back into the banking system, just increase the interest rate and the cost of funds will become very expensive. People will not borrow, money will flow in. And likewise, if they want to stimulate the economy, of course, the Bank Negara will then reduce the interest rate, causing more outflow of funds and thereby making the economy more, stimulate the economy and making it more robust until to a point where inflation begins to set in. So as the market interest rate rises, the price of fixed interest rate instruments will decline, right? Market interest goes up, the fixed rate instruments will definitely decline. Now, the relationship between the market rates and the fixed interest rate will always hold in all cases. irrespective of what kind of factors like changes in your credit worthiness, and all that will not affect the market rates because this is dependent on a different factor. All right. So you also have the risk of interest rate. You have also other price risks that will be affected. So a broader concept that evolves around the interest rate risk is other price risk. This is the risk that the fair value of a future cash flow of a financial instrument will fluctuate. Why? Due to factors specific to the financial instrument. All right. Now, future cash flow of a financial instrument may fluctuate. If you have, investment in a bond or investment in a commodity, a foreign commodity, that price will fluctuate depending on the risk factors. So a price risk, which will include risk of changes of the commodity prices on international markets. So that will be other price risks. The cash flow will be affected. So we were talking about other price risks. Just on here. Okay, thank you. So other price risks. So the broader concept about the interest is also on prices. Interest will affect prices. And when prices are affected, future cash inflow will be affected. So all this is on your instruments, which is trade receivables or other investments that you have, or investment income like interest will be affected. So we need to disclose, as I was saying, it all depends on, not depend. It all is required because user of the financial statement wants to know where are the risks. Let's say if he perceives that the world interest rates are going to go up, then he will understand what will be the effect on the company that he's buying, that he's investing in, or what will be his investment looking like. Now, if he feels that the Malaysian interest rates are going to go down or up, whichever, he will also know in terms of a Malaysian company what will be the financial effect on the profit and loss and eventually on the balance sheet. So this is what analysis of financial statements are. And today, because of the ability of information that is so easily obtainable, and because of the availability of your handphone, your iPads, where you can easily get information just by looking for the information, Google it, and you'll get the information. You can understand what is this all about, and they get to understand it better. So when people read about this, they want to know the company in which they are investing, what is the various risks involved, right? And then you have the credit risk. What is a credit risk? A credit risk relates to a loss that may occur from the failure of another party of a financial instrument to discharge an obligation in accordance to the debt. Simple language. Credit risk means collectability of debts. All right. Can you collect? Yes, you got a good amount of sales. You got good profit. You got a good amount of, the trade receivable. You have done all your assessment of trade receivable, 12-month expected credit loss, lifetime. But you also must understand beyond that, there could be a credit risk that doesn't show itself now, but may come into being in the future. So you need to state that there is a credit risk. So let's say an investor wants to invest in the company. He might think, all right, these are the receivable. Well, I will give it a discount of about 10 or 15% to counter the credit risk that I think they may not be able to collect. Although you have provided for everything, but I want to be more cautious. What if another 10 or 15% is written off to the P&L? How will the financial statement look? I can do a mental calculation on my account, or I can do it, on the iPad or whatever, and then see, okay, am I still comfortable? What if 20%? Okay, the margin is good. I'm comfortable. I invest in this company, or I shall not sell off my investment in the company. So decisions are made on the basis of risk. A risk is something that will happen in the future, may not happen, may happen, but it is up to the individual to assess that risk. It's not for us to tell them no risk. You make that decision. So that's why it is a two-way thing. You give the information, these are the risk areas, let the stakeholder understand what he feels about the economy, and he makes his own decision. Sometimes two investors have two different opinions because nobody knows exactly what what really will happen. So that is why these risks are disclosed. And then the liquidity risk, whether the company's got money to pay. The risk that the entity may encounter difficulty meeting obligation simply because the company cannot roll the money, if you talk in simple language. All right, money is not rolling. You are actually selling, you are buying new goods to sell, you are paying your creditors, but somehow the money that you have uh, sold, the goods, is coming in very slowly, trickling in. So that is a liquidity risk. Or maybe you can sell the goods and they are paying. But the problem is the inventory level is high and you cannot get rid of the inventory. And that means that you will be tied up in the funds again because cannot sell. Or maybe the inventory is of a type that is already now no longer people looking for it. They're looking for a different product or a newer product, right? So all these things will have an effect on the type of goods that you sell and whether or not you will be liquid if you can sell it. So if you're selling clothes, for instance, you have got a lot stock of clothes, but then fashions have changed. So people look at your clothes, oh, this one old fashioned, I don't want to buy it. I look like a old fashioned person. I want to buy the new one. Now the new fashion is like that. So what are you going to do with all of that inventory? You cannot sell. If you cannot sell, you cannot convert to cash. You might get a liquidity risk. So you see, it's not just confined to one aspect. It can be on many aspects on the balance sheet. If you understand the big picture on the balance sheet, that's what students need to understand. Not the narrow picture of a balance sheet or profit or loss, the big picture. Because analytics is the very important part of finance. All right, analytics. To just look at numbers is a bookkeeping work. And I don't think university students are interested in bookkeeping work. That we leave it to the LCCI or whatever that they have now for those. But here you're looking at analytics. When you come out to work, you're working in a position of a financial controller, a bank, a finance department, or things like that. These are things that we need to understand. All right. And the user, whatever you're presenting, it's the user. It's a two-way trade. The bank doesn't exist without the user. The user cannot exist without the bank. Because ever since the dawn of banking system centuries ago, this becomes an inseparable partnership. So therefore, giving disclosure and being as transparent as possible is very good for the stakeholder. All right, next one. Summary of the disclosure requirements. So MFRS 7 requires that the carrying amount of each of the following categories as defined in MFRS 9. 9 is the main standard. 7 is the disclosure standard, remember. All right, are required to be disclosed either on the face of the statement of financial position, that means on the face of the balance sheet, or in the notes. All right, either on the face or in the notes, or either, or maybe in both. Now, financial asset at fair value through profit and loss, you need to show those designated as financial asset through profit and loss on initial recognition. So if you have an investment and that investment is in investment in shares, so the investment in shares is designated as fair value through profit or loss. So all changes in fair value will go to the profit or loss account. Now you have a one-time irrevocable option, right? If you buy shares at fair value, that category of share can be put as fair value through other comprehensive income. So if you put it at fair value through other comprehensive income, it will not distort the profit and loss account when fair value changes take place. It will distort only the other comprehensive income, which goes directly into the statement of the statement of equity. It goes in the equity, one of the columns in the equity. And when the share is eventually disposed of, then the loss will come back, recycle back to the profit or loss. And that's fair value through profit, through other comprehensive income. Okay. Now, also financial liabilities. Sorry, here I said this on initial and those mandatory classified at fair value in accordance with MFRS 9. Basically, most of the investments in shares will be at fair value to profit and loss, except when you make that one-time irrevocable decision to put it in OCI. Now, financial liabilities can also be shown initially at fair value through profit and loss account, and those that meeting the definition of held for trading. Held for trading means you're holding the shares intending to sell it, not the old definition under 139. Held for trading, not that one. It's here you're holding it to eventually sell it. Your intention of buying the shares is to hold it and sell it to make a gain of the capital gain that you sell when you sell the share, as well as to earn the dividend income. That will be a definition of held for trading. Okay. And then financial assets measured at amortized cost. So all let's say a loan that you give to a director, loan that you give to subsidiary companies, or loan to staff, they are all financial assets that are measured at amortized cost in a normal company, but in a bank, they are actually loans given to companies, given to individuals. They are also measured at amortized cost basis. All right. So therefore, you add the interest and then you take out the payment, etc. That's called amortized cost. Likewise, any liabilities that you get, you also show at the amortized cost basis, just the opposite entries. And financial asset measured at fair value through other comprehensive income, which I mentioned just now. You have a one-time irrevocable option to do that. Then you can show separately financial assets measured at fair value through OCI, mandatorily under MFRS 9, and also investment in equity instrument that are designated at fair value through OCI based on your option to do so. Right? So other financial method measured at OCI will be things like, retirement benefit fund, stuff like that. All that will go into OCI because they are longer term. They don't go into P&L account. Okay. So that's when we are talking about financial asset at this. All right. So any fund that is relating to a retirement benefit fund extra, any assets relating to the fund. Now, summary of disclosure, special disclosures apply to those financial instruments, financial assets and liabilities that an entity designates that are to be classified under fair value through profit or loss, which otherwise would have been measured at fair value through other comprehensive income or amortized cost. Now, when do you do this? This will be special disclosure. When you designate something to be classified at fair value, actually it should be other comprehensive income, but you put through P&L. So the maximum exposure to credit risk of a loan or receivable at the reporting date. What is the maximum exposure to credit risk if you give a loan or receivable, right? And the amount by which the relative derivative or similar instrument mitigate that exposure to credit risk. So this is hedging. All right, this is simply hedging. If you got let's say a credit risk of a loan that is given to a foreign company, all right, and so you have a receivable that is receivable in a foreign currency into Malaysia, and the Malaysian ringgit and the foreign currency will fluctuate. So you might get a gain or loss. How do you mitigate this gain or loss? So you will go to the bank to get a derivative, all right, otherwise known as a hedging instrument. A hedging instrument is a derivative. It derives itself from the fact that you have the principal transaction, which is actually a loan to another company in a foreign land in different currency, right? So therefore, the problem is when it's repaid back slowly, you have a currency risk, but you want to mitigate the currency risk. So you go to a bank and either you buy forward currency or you get a derivative, either way. So these are the ones that will negate. When the currency goes down, the derivative will go up, right? So whatever loss you make here will be offset by the profit. Of course, it's not directly, completely offset. There will be at least a huge percentage, all right? There will be amount of gain or loss, but not 100%. Now, that will be a perfect, situation where you can actually risk like that. Now, not all companies will do that because when you take this derivative from the bank, all right, to mitigate your risk, there is bank charges involved. So again, how much bank charges are you willing to mitigate on this risk? So you'll have a balance of, how much you should pay and how much you think should be okay, because certain things that are if the risk shows a smaller amount, that's not going to be very material. But if it shows a higher amount of loss or gain, that will affect your P&L, which you don't want it to do so, right? So this is where one counterbalances the other. Now, the next thing is the amount of change both during. Now, I will explain a little bit more when I talk about hedging. All right, then you can get a widest perspective of this. Now, also another disclosure: the amount of the change during the reporting period cumulatively and the fair value of the loan receivable, right? That is attributable to changes in the credit risk of the financial statement. Now, let's try to understand. Very complicating sentence. The amount of change, right? What change? Both during the reporting period and the fair value of the loan receivable. You have given a loan, right? What is the fair value of the loan receivable? All right, it's of course after the interest, right? So the fair value is the net of interest and time value of money. So the amount of the loan and the fair value that's attributable to changes in the credit risk of the financial asset. So again, you're given a loan. The credit risk is what we went through, all right? The probability of default, the loss given default, and also the exposure at default. All of this will come in, and that is the interplay between what you give out and what you expect to receive, right? So that will be the attributable changes in the credit risk of the financial asset. The probability of default is the credit risk. As the amount of change in the fair value that's not attributable to changes in market condition that gave rise to market risk, right? As the amount of change in the fair value that is not attributable to market conditions, all right? It's not attributable to market conditions, but due to the probability of default. Or using an alternative method, the entity believes more faithfully represent the amount of change in the fair value attributable changes in the credit risk. Now, alternative methods seldom used. Usually the use is the probability of default method. All right. But just to know that there could be alternative methods. Now, the amount of change in the fair value of any derivative. Derivative is the item that is taken to compensate the principal item going up or down. This one is going in the opposite way. All right. So this is the amount of change in the fair value of any related derivatives or similar instrument that occurred during the period and cumulatively since the loan receivable was designated. All right. So any change in the fair value, which is actually how much you can collect. The amount that you can collect is the fair value. All right. Now, why financial instrument disclosures are critical? Why put them at all? Sometimes people don't understand. So much of thing is written, blah, blah, blah. Why show it at all? Right? So both MFRS 9 and 7 tell us what numbers to recognize. Right? MFRS 9 is what numbers to recognize after we have done all the probability of default, the loss given default, and also the exposure to default. After all that tells us what you should recognize under MFRS 9. But MFRS 7 tells the user whether those numbers can be trusted. All right. Now, you may be wondering, what do you mean by those numbers can be trusted? You calculated. We calculated based on a large number of assumptions, the probability of a default. We never said it is an actual default. We are giving a loss given default. We are talking about exposure at default. All these are estimates. All right. So that are the numbers based on the estimates we recognize in the accounts. But the disclosure will tell us what numbers can be trusted, whether those numbers can be trusted. In other words, we are giving you these accounts, Mr. Stakeholder. You make your own decisions. This is decision made by the company. It may be right, it may not be right. Economic conditions may change as you are reading the financial statements, which may not come out until the next financial statement come out. So you're reading something, economic conditions change. So The stakeholder cannot say, hey, I thought I saw the accounts is like that. Yes, it was at that point in time. Those are the numbers recognized. But do you trust them since the economy has changed? So you have to make your own decision to the user. All right. This is more important to tell the user what it is. You're not saying the numbers totally cannot be trusted. But the thing is, if you trust the numbers, don't say that the company gave the numbers. This is based on situational needs, the economic environment at that point in time. So disclosure under MFRS 7 allows user to understand the risk exposure, probability of default. There's a risk, all right? Understand it, and also evaluate the management's judgment. Management made a judgment on the probability of default as well as the loss given default, and also any estimation uncertainty in this too. So evaluate: do they agree or don't they agree? Do they think they know something in the economy, or they feel very strong the economy is going to turn around and go up, or the economy is going to get worse? Like today, if you look at the situation, is the economy going up or going down? Is the economy going to go up or going down in the next 1, 2, 3 years? If you listen to what's happening in the news today and the last few days, about what Trump is saying on this and what is Trump is saying on that, warning Iran, warning this, want to take over Greenland. Now, all these are very unsettling. What if he does? What if he doesn't? What if they are just threats? Do we know which way it will go? So all this probability of default that you calculated is based on the situation now as it stands today. But moving forward, it's for the investor to decide. So he is the one who's going to assess what management judgment made and this estimation, whether he can believe it or not, or if he feels strongly, no, there's going to be a lot of war and probably even something more serious is going to happen. The economy is going to collapse a while before it turns around, and I want to pull out my money. Maybe. Or he may think that, well, all this is about a lot of hot air. US has not been able to do this or that or whatever it is. And he may think that, no, I think I'm impervious to all the goings on. And I think I'm still quite confident in the economy. I think the underlying strength is still there. The trade is still carrying on. You see, both ways you can argue who is right and who is wrong. Do we have a crystal ball to see? We can't see. All right. So that's where investor is the one who has to make that decision, whether he wants to invest or whether he wants to withdraw from the investment. So all these are what the user is going to do. And this is written in the notes. And also the user will assess changes in risk over time, especially credit risk. So he can identify, all right, what is the risk situation in the world. And if the world situation is deteriorating, the credit risk of the company and all its collectability will become even worse. And therefore, he makes a decision, right? So this is where the disclosure actually, supports the actual MFRS 9 figures that are shown separately. So this is the disclosures that are shown, okay? And now the structure of the MFRS 7 disclosure. So MFRS 7 requires something like 3 disclosure pillars. 3 pillars. What are the 3 pillars? Now, pillar number 1, the significance of financial instruments. How significant are they in terms of the balance sheet and profit or loss? In other words, balance sheet and performance impact. I still use the word balance sheet because typing in statement of financial position is a long word, and I just wanted to put balance sheet, but it is actually the statement of financial position and the performance with the profit or loss. So pillar number 2 is the nature and the extent of the risk. First, impact on the performance. Number 2 is nature and extent. That's when we talk about the credit risk, the liquidity risk, and the market risk, right? And there are other few risks as well. So all of these risks is called the nature and the extent of risk. Pillar number 3, how management is managing the risk. Yes, you say there are credit risks, there are liquidity and market. How is management managing it? What are their policies? What are their assumptions? What judgments have they made? And the user of the financial statement is reading them in his own knowledge of the economy and the numbers and all the situations in the world. He makes his own decision after reading the management's decision. He either concurs with them or he comes up with a different decision. And that is the basic thrust of disclosure. Significance of the financial instruments, nature and extent of risk, and how management manages the risk. These are the three main pillars of the disclosure for financial instruments, right? And then pillar number one, let's go in detail. The significance of financial instruments. So the statement of financial position disclosure, all entities must disclose the carrying amount of all financial instruments by category. For example, those that amortize cost, those that fair value through OCI, and those that fair value through profit or loss. You must disclose by category. And you must distinguish the financial assets between financial instruments between financial assets and financial liability. It's a requirement. Don't only list the balances without explaining the classification difference. Don't only list it. You have to show the classification difference. All right? Don't put the balance itself. So let's take an illustration. A balance sheet disclosure extract. These are made simplified. Now, a disclosure. Trade receivable amounting to 12.4 million are measured at amortized cost. Right? And then an allowance for expected credit loss of 0.6 million has been recognized. Now, this is telling you as a disclosure. Now, measurement category explain why fair value volatility is absent, right? The measurement category measured at amortized cost. Amortized cost is a fixed way. Now, fair value volatility is not shown in amortized cost because amortized cost is different from fair value. So this category of trade receivable at amortized cost shows why you don't take fair value. All right. Now, expected credit allowance, this one, allowance for expected credit losses has been recognized. ECL allowance signals there is a credit risk exposure. That means there's a risk exposure. So the management has decided that expected credit loss or expected risk is about 0.6 million out of the 2.4. So as an investor or as a user of the financial statement, is for me to decide, do I think the credit loss of 0.6 is adequately provided for? Or do I think otherwise? Or I may think that it may be a little bit understated. I might want to put 1 million or maybe 1.5 million out of the 12.4, knowing what I know in the economy of the world. Right? So some investors may look at this that way. And some will say that I think 0.6 is really fair. No problem. If management feels, I will go on to them. Or some very optimistic stakeholder may say, why do they provide 0.6? I think even 0.2 or 3 will be more than sufficient. Now, all depends on the investor. People who invest have different risk appetites. It's up to their risk appetite, how they look at it. Some are very people who like to take a lot of risks, and some who are very risk averse. But this is the type of investing people that we have in the world. You need both types, and people are of both types. Anywhere between risk averse and a risk taker. So, therefore, this kind of notes gives the reader to be to align his own risk appetite with what is shown in the account, and therefore whether he will go for this company or he will not go for this company, right? And then the statement of comprehensive income. Just now we did on the balance sheet. Now statement of comprehensive income. Disclose interest income by measurement category. So of course interest income must be shown. People want to know, how much is your loan given, how much are you recovering in terms of interest. Your loan may be a higher portfolio, but your interest is very little, right? So that is another issue. Impairment losses, are they recognized? So the expected credit loss. Were there any fair value gains or losses as a result of the item being taken up on a fair value basis? Whether there's fair value gain or loss, right? And then the next one is the pillar 2, credit risk disclosure. Now, this is very important, the credit risk. Now, in terms of credit risk, what users want to know? What does the user want to know? Why disclose all of these things? Just to fill up the accounts? No. Is what user want to know. Users of financial statement will be asking questions like this. How risky are the financial assets of this particular company? How risky? Can I collect them? Are the investments safe? Is there a potential that the investment in the bond may fail? The investee company, the company in which the bond has been this thing, will it fail? And therefore, they can't even collect the interest and don't even talk about the principal on the bond. They are looking at how risky. And how do you tell people how risky are they? By exactly what we are doing. The assessment by the company on the probability of default and also the loss given default, and most important, the exposure at default. So you see, by using all this is what management has a methodology to show it in the notes. And this methodology has come out as a result of MFRS 9. Right? So there we disclose all of this. How risky is the financial asset? How much judgment is involved? Would the investor believe the judgment by the directors? Now, many factors come into play here, right? In the real world, will management will the reader of the financial statement judge? He will first look at the directors. What is the character of the directors of the company? Now, these are real. No doubt you might say, oh, sure, the director should be okay. No, it's about the character of the director. There are all kinds of directors in the world. All right. Otherwise, there will be no fraud at all. Right. There will be no fraud in the world. You will have a perfect set of, world with no fraud whatsoever. Yet there are so many frauds in the world. Right. So there will be directors who might tweak it to make things better. Then again, you have the check and balance, the auditor. The auditor is supposed to check, will be also looking at it to see whether he concurs with what is stated in the account in terms of the risks. Or does he think there's a material misstatement in the financial statement, in which case he will have an audit qualification. If he has an audit qualification, you can read that. What if he does not? Now, you ask this question, what if he does not? How can auditors do that? Look around the world. So many fraud cases have occurred in the world. We are not talking about the small one. We are not talking about the junior staff taking 10,000 or 15,000 somewhere. No, we are talking millions of ringgit, millions of dollars that are stolen, that are taken from companies, with so many fraud cases around the world. And those auditors are not small auditors, right? They are not the Ali, Achong and Mutu chartered accountants. No, they are all big firms. How can the fraud take place, right? So sometimes you have to wonder all these things. So that's why how much judgment is involved depends on how they rate the directors, how they rate the auditors, and then they rate themselves on the account, what they think it should be. Does it jive with what the directors and the auditors have concurred with among themselves? Do their own personal belief this thing? So this is where the user is asking how much judgment is involved. And the third one, is the credit quality improving or deteriorating? If you don't have a disclosure, nobody will know if you read last year and this year whether the credit quality is improving or deteriorating. Is this company in a downward sliding mode? That means all the credit quality of all their financial asset is getting worse. All right, collectability is getting tough. What can you conclude in this case? Management is not, managing the assets carefully. And so it is sliding. So this disclosure gives the idea to the user. Now, if you did not disclose and you keep quiet, the user sees a set of numbers on the balance sheet. Okay, this is the probability of blah 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 blah. Okay, so that's correct. Okay. So when you describe it more, it becomes the reflection of what is stated in numbers in words. So now I can look at this and I can look at this and make a more reasoned decision or a judgment. And so that's why users want to know all this about the credit risk, which is in a narrative form and also in analytical form in the notes on the accounts. Now, the core credit area, core risk disclosure areas will be exposure to credit risk, right? First thing is the exposure to credit risk. What is the credit risk management practices? So again, this is something that the company must be doing and explaining how they manage the credit risk. Credit risk will always be there. Left unattended, it may damage the company. It may cause the company to make a lot of loss. So how do they manage the credit risk? And then what is the expected credit loss? And what is the methodology the company used in assessing the expected credit loss? What is the methodology they used? So we explain on the expected credit loss. And that's where to get the expected credit loss, we went through all that example that talks about the probability of default, the loss given default, and also exposure at default before you can come to the ECL. Remember all that workings we went through? So here again, what is the methodology? Here describes the methodology. You don't have to put all the details in, but the methodology. Assess the probability of default, assess the loss given default, and also the exposure at default. And we worked out the expected credit loss, arising from all of this. And then reconciliation of loss allowance. Remember, I showed you the note just now, opening balance, transactions during the year, what moved from, from 1 to 2 to 3. All right. So how was the credit deteriorating? So, and then what was the closing balance? And that is the reconciliation of the loss allowance. And then what is the sensitivity to changes in assumptions? In the event that the economy improves and the interest rate goes up, this is what is going to be the effect on the account. If the interest rate goes down, this is going to be the effect on the account. So this is called the sensitivity analysis, which is normally done to give users an idea without they having to take out calculators and whatnots to calculate, or the handphones to calculate using the calculator. They can read, what if this goes down by 1%, it goes down by 1%, what's going to go up, but it goes up by 5%. So people can understand where are the parameters that the range is. If I lose, how much can I lose? If I gain, how much can I gain? So I know my parameters. How much loss am I willing to take maximum? All right, if this goes down by so much, I will make a loss. Okay, I can live with that. And so I might continue to invest and hope that it goes on the upside, not the downside. In the downside, I already know how much I can lose. Then I will cut my loss. So that's why this is the sensitivity to changes is all about the user's requirement, user's understanding. Now, that's the whole thing. Exposure to credit risk. Required disclosure is what is the gross carrying amount? Where is the credit risk concentration? Who are the type of customers? Where is the geographical location where the customers are located? Most companies will be Malaysia, but a lot of companies will have customers located in many countries. And what type of industry are you in? So you will also know by the industry what is the credit risk. All right. So if you're looking at iron and steel or production of steel industry, you know very well this kind of industry is very well dependent on the growth of the economy. If the economy is going down and construction work and the development work is slowing down and the government does not put in much money into infrastructure development or pumping into the economy, then this kind of industry will fall flat very, very fast because it's very high investment. You need to have maintain a certain amount of sale. So that's why, again, what industry that you're talking about? Similarly, as I said, if you are doing some kind of manufacturing for the building industry, all right, certain kind of product for the building industry, like a PVC pipe or whatever, UPVC pipe, whatever they use it nowadays. Now they don't use lead pipes anymore. So all these under pressure or non-pressure pipes. So if the building industry falls, it will necessarily follow that the manufacturer of these pipes will have an impact on them, unless they can mitigate it by exporting to other countries where it is. So then again, price risk. Then again, the you know the currency risk, because when you export, whether the currency goes up or down, there's another fact there. So all these are the things that users who are informed investors will be looking at. And then they will be looking at the collateral. All right. Now, let's say like banks. So if you want to buy a bank share or something, you'll be looking at, is this bank doing well? Was this bank not doing well? All right. Now, this is not so much in Malaysian banking. Malaysian banking is very tightly controlled by Bank Negara, as we all know. Because Bank Negara, they have the Banking Act that can actually, they are always in all the banks, continuously auditing. So the minute a bank shows signs of weakness or potential weakness that might arise, before that already Bank Negara would be talking to the bank to try and get somebody to merge with you or whatever it is, or put in additional capital. Now, banking money capital is not like a Sendirian Berhad or a Berhad. It goes into a lot, a lot, a lot. So sometimes you can't, the banks will be asked to merge. And so before you know it, the banks are still strong. Nobody of them know one bank was weak. Now, has any bank in Malaysia ever had a run on its on the bank? People running on to take out money? It never occurred. But they have in other countries, right? That's because of the way the Banking Act is designed, and Bank Negara control is very, very tight. So here again, when you want to invest, sometimes you want to know the extra qualitative features. What extra that you have makes it more secure than another bank, right? So you have more collateral or high quality collateral, then I would want to invest in this bank's shares, things like that, right? Now, illustration number 2, the credit risk concentration. All right. Now, credit risk concentration will be like this disclosure. Approximately 45% of the group's trade receivable relate to customers in the construction sector. All right. So trade receivable is construction sector. No single customer accounts for more than 10% of the total trade receivable. So 45% of the trade receivable is in the construction sector. If the construction sector is very buoyant and very progressive, and there's a lot of investment in the country, definitely this is a growing sector. And it is also controlled by the fact that no single customer is holding a large amount of portfolio. All of them are less than 10% of the receivable, not more than 10%. So anyway, even if one customer, for whatever reason, fails and close shop, the bank will not suffer, or whoever it is will not suffer, because it's only confined to 10%. And even then, it may not be the full 10%. There will be probably whatever facilities that you're given, there will probably be also a kind of a collateral, which you saw just now. Collateral can also be set off, right? So the point to note, concentration is not equal to default. All right, concentration on the construction sector does not mean it's going to be defaulted. Concentration increases a systemic risk, not individual risk. A systemic risk here is the construction sector risk. Will there be a situation when suddenly the government, for whatever reason, raises interest rates, constricting all kinds of cash flow? And so businesses may be forced to reduce their facilities and therefore cannot pay. Now, that is called the systemic risk. Of course, it may not happen, but if it does, they could be happening in small stages. A 0.5% increase in the bank interest rates, right? What will be? How many percentage point increase? What is the impact? So this is the systemic risk if that such a thing exists, not an individual risk of a customer, right? So therefore, you can see that 45% is on construction and no one is more than 10%. And this is more of a systemic risk. So the ECL method disclosure also must be shown. So simplified disclosure do not explain what the standard require. Just write one-liners and two-liners. No. What must be disclosed for the expected credit loss? You must explain how the ECL is measured. And that's why I took the painstaking task of going through and highlighting the main areas of how ECL is finally arrived at. Now, that example is good for you to use for your students, right? To learn the big picture. Now, inputs and assumptions are important. What are the input and the assumptions to the ECL? Using forward-looking information, not historical. Today, we are all on forward-looking. Remember, financial reporting is today forward-looking. Gone are the days for financial reporting was some bookkeeping work, recording what had taken place and trying to figure out when the whole world is moving forward, we are looking backward. Debit what? Credit what? This one correct? That is something that will be done. But financial decisions are made looking forward. So that's why forward-looking information is very important to highlight to everyone. Sometimes even accountants don't seem to understand this because some of them may have been trained very long ago when accountants were only taught to look at historical information, not so much as even current, not to mention forward, right? But today the world has changed so much, and that's why there are so many changes in the accounting standard to cater for this forward-looking things. There are a lot more, but today we won't discuss that, right? Because we are focused on the MFRS financial instruments. So changes in estimation techniques. So if you're talking about your probability of default, if you change the probability of default, that's a change in an account estimation technique. If you change your loss given default, these are judgment, then you have your estimation techniques different. And exposure to default, exposure at default is also a judgment. All three play an important role in the ECL. So this is where you are looking at how the whole note will explain to the individual. So let's look at this ECL methodology narrative. There are many, many narratives. There's one of them. Expected credit losses are measured using a provision matrix that incorporates historical default rates adjusted for forward-looking macroeconomic factors, including the GDP growth and industry outlook. Now, this disclosure links the numbers to the economic reality, which is macroeconomic factors and the GDP GDP growth and the industry outlook, directly linking. Now, if you do not put the macroeconomic factor, if there's an absence of macroeconomic factor, that will be a very weak disclosure. It doesn't give you the perspective under which your expected credit losses have been made. I can't see the big picture in simple language, right? Now, the key requirement will be entities must disclose what forward-looking information is used. What forward-looking information is used, and also how it affects the expected credit losses requirement. All right, measurement. You must look at this forward-looking information. What forward? So all this probability of default is a forward-looking information. It's not a backward-looking. All right, loss given default is a forward. You think that'll be the loss, and of course, exposure at default is forward. So this is what you need to understand. And then forward-looking overlay disclosure. So let's look at this disclosure. Management applied an overlay to the historical loss relates to reflect increased default risk arising from higher interest rate and tightening credit condition. So this is the historical loss rate. It has been overlaying the historical loss to reflect increased default risk, because if historically you were losing, now with the higher interest rate, you are going to make a bigger loss. And because of the tightening credit condition, those that were historically going to be a loss may be even a bigger loss. So this is an overlay, as they call it. So the point to note is forward-looking overlay are judgmental call. All right. So this is a judgmental call because you never know exactly what happened. Nobody can predict the future. If you can, all accounts will be done in the future. But it cannot be done that way. So you assume, make certain assumption, and that is called a management judgment, right? Judgment call. They are not mathematically precise, no matter how you calculate correctly. What is the probability of a default? Is a probability of a default, not actual default. So this disclosure explains the movement, not just ending balances. So illustration, we have expected credit loss reconciliation table. The opening loss allowance, 420,000, let's say, increased due to new receivables. All right. Expected credit loss is 180,000 ECL after all the calculations. Increased due to credit deterioration, not paying on time. Credit deterioration, 95,000. All right, this 420,000, 180,000, this 95,000. Let's say there were 1,000 I didn't put up. So what are the write-offs? Totally cannot recover, 60,000. What is the closing loss allowance? 400 has now increased to 635 despite writing off 60. So what are the main points? Students must learn to link the movement to business event. That is very important to know. Just reading the textbook, not knowing the external influence, that numbers that we create is meaningless, totally meaningless. It must be a direct correlation to the business events taking place. So this is what students must be told to do as well. Understand that the numbers here mean nothing if you don't relate the real world events to it. You must also distinguish new exposure versus credit deterioration. New exposure means a new debt that may be now exposed to a credit risk and could become an expected credit loss. That's a new debt. Now, credit deterioration means existing debt that was already expected credit loss, now deteriorating to even worse, going through level 3 or stage 3. From stage 1, stage 2, going to stage 3. So in that case, you have to actually make them understand not only old one, but new one as well. So don't always think that, oh, credit deterioration is the existing debt. You must look at new exposure of debts as well. Just because it's new, it does not mean. Remember, the minute you give a debt to somebody from, sorry, I was eating peanuts earlier. Something tickled my throat. Sorry. All right. Sorry. So what I'm trying to say is the student must know that new exposure does not mean nothing. From day one, you give a loan or a debt, the possibility of not recovering is already there. We normally, in commercial situation, we do a matrix table, all right, showing how many months, how many months, it increases if it deteriorates. But here we are talking about bank one, is more complex, right? So let's look at a case study now here on a disclosure, trade receivable disclosure of a retail entity. And this is a retail group experienced slower collection. So retail, slower collections, higher customer defaults. Remember, all this is business to business, no retail to a customer. Today, we don't do that kind of business. It's business to business, wholesaler to retailer, things like that. So higher customer default and then rising interest rate. Now, this retail group experiencing three different whammies: slower collections, higher customer default, and higher interest rate. Now, higher interest rate means money is tighter, a little bit tighter, right? So let's understand the impact of weak disclosure and a strong disclosure. What is a weak disclosure and what is a strong disclosure? So let's look at weak disclosure, trade receivable. The group has recognized expected credit loss on trade receivable based on past experience. This is called written by someone who has no knowledge of the details of the standard. So, must show expected credit loss. Okay, I'll show you that. The group recognized ECL on trade receivable based on past experience. Does it even give any information? What has past experience got to do with the current and the future? Is the past always going to be the same in the future? I know history repeats itself, but is the past the same as the future? No. You are giving one side of the situation. So the improved disclosure will be something like this. The group recognized an increase in expected credit losses arising from slower customer repayments. This is what they experienced, and from higher default rates in the retail segment. The loss rates were adjusted upward to reflect higher interest rate and reduce consumer spending. Now, doesn't this tell you a much better picture that you are expecting an increase in the credit losses because of slow customer repayment? All right. Customers are repaying slowly. That's a point of fact. And also higher default rates in the retail segment. So if you look at the retail segment, everywhere there could be a higher default rate. And so the loss rate, expected credit loss, was adjusted to reflect two major things. Because of higher interest rate, money is tighter and reduced consumer spending due to the tight money as well. So because of these two things, the loss rate is going a little bit higher. Well, now, doesn't this tell you a better story than the group recognized expected credit losses based on past experience? What past experience? Future? No. So weak disclosure. Now, let's look at another case study here. And this is loan receivable disclosure of a manufacturing entity. Let's take a simple scenario. A term loan was granted to a distributor. All right, manufacturing to a distributor, you give him a term loan. And then there is a covenant breach during the year. Maybe the current liabilities exceeded the current asset, or maybe the profit was not up to what is required in the covenant, one of those, or maybe others, or maybe the borrowings became higher than the equity, the debt to equity ratio became higher because they borrowed from directors or borrowed from related companies. So that could also have happened, covenant breach. Loan still okay, not yet in default, all right? So the disclosure here will be during the year, the group identified a significant increase in credit risk on a loan receivable following a breach of the financial covenant breach, right? So here's the covenant breach. So they identified a significant increase in credit risk, right? SICR on a loan receivable following a breach of financial covenants. As a result, the lifetime expected losses were recognized. Now, this disclosure is telling you one thing: migration from stage one to stage two. And so this is a disclosure that tells you because of the financial covenants, they are moving on to stage two. But it's not stated as stage one or stage two. It is telling you lifetime expected credit losses were recognized. If you remember just now in the example, this is when lifetime expected credit loss will come into play, but interest is still on the full amount. Okay. And then sensitivity analysis and estimation uncertainty. Now, what are the required disclosure for sensitivity analysis? Sensitivity to changes in assumption. When you make assumptions, all right, nothing in the assumptions is accurate. What if the assumption is out by a certain percentage? So sensitivity must also be shown. Uncertainty in the expected credit loss estimates must also be shown. Uncertainty. All right. So all your ECL, which you use the probability of the default, etc., you have to state what are the uncertainties here. So let's look at another illustration on sensitivity disclosure. So a 1% increase in the loss rate would increase the expected credit loss by approximately 120,000. All right. Increase in the loss rate. So the point on this disclosure is it demonstrates an estimation uncertainty. It helps users to understand that this 1% is a model and there's a risk on this model. What if it's 1.3%? What if it's 1.5%? Then the credit loss will go higher, right? So this is a model risk. So now the link between the thing we are summarizing again between 7 and 9. MFRS 7 or 9 is recognition and measurement. MFRS 7 is transparency and accountability. So in substance, MFRS 9 creates the number. That's how we created the number. Now, MFRS 7 actually tells you, does the number make sense or not? Does it make sense or does it not make any sense? So that's the difference between the two standards. So some of the exam teaching pitfalls, we need to caution students against listing disclosure without explanation. Just because it's a disclosure, you list it down. You must explain for all the reasons that I went through in the last few slides. Right? You must not ignore reconciliation table. You cannot understand without a reconciliation. You cannot understand. User cannot understand, right? If you fail to link a disclosure to economic condition, your disclosure is devoid of external influence. Because external is what's going to affect the company. Internal is already by itself. External will also affect the internal. Because as you saw just now, if the interest rate rises, money is tighter, people may find it difficult to pay. And so payment may be slower. And that is the external affecting the internal. And like that, many other factors. Economic downturn, right? New technology comes into the market. Like a simple example, all right? Once upon a time, what phones did people use? They used what's this? Motorola, all right, and also the other one, the Swedish phone. So these were the type of phone that was the way of life. Suddenly, Apple came into the picture. Nokia, the other one's Nokia, all right. So Motorola and Nokia was the way of life in the olden days, in the 90s, in the 2000s, and even in the early 2010 onwards. But then when this Apple came into the world in 2008 and into Malaysia in 2010 or 11, I can't remember, a lot of things changed. Nobody talks about Nokia. Nokia is dead. So it's this kind of thing. Technological changes, if you cannot see it coming, these kind of companies will die. Right? If they don't change the product straight away, they will die a natural death because they still believe, no, this was the thing of choice. What is all this Apple coming to the picture? Today we have a different scenario altogether. Technological changes are changing so very many things, right? In so many areas, for that matter, where you can see today technology has changed a lot. So therefore, when you look at this, you must understand listing something without explanation makes no sense. Have to explain. Reconciliation tables are important. linking disclosure to the economic conditions that I just explained on the phone, and treating the expected credit loss disclosure as standard wording. There is no standard in a good set of financial reporting. There is no standard. Standards are those people who don't know what to do, copy and paste. Oh, the fellow got I put inside that one also got put might as well put that is called irresponsible financial reporting, right? You may see that in Sendirian Bahar, but in big companies where you're talking about real disclosure, this is definitely a no-no. It can never happen, right? So some final thoughts on disclosure. Financial instrument disclosure are not a compliance exercise. Oh, you say must do, I do lah. No, it's to give information. They are supposed to communicate the risk. They are supposed to communicate the judgment. They are supposed to communicate what uncertainties there are, so that the user of the financial statement is able to make a reasoned judgment. Now, if you have a poor disclosure, it means you got a very poor risk management. You don't know what to disclose, right? Now, if time permits, we'll review further example, but we may not have time. But anyway, this is what it is. All right. So this is after the break, we will come back. We look at hedging. But now, any questions on the disclosure? Actually, I might want to go into the other one. I'm scared that once I change, I might have a problem. I will try anyway to see what I can look in the notes that I've given you to see whether anything. So I'm going to stop sharing this, keep my fingers crossed, and bring on the other Word file. Right? Can you all see the Word file? And is it moving at all? All right, it is moving, good. So we went through this. I'm going to go back to the beginning here and talk a little bit about, this expected we have done already. I want to go more on a little bit on the disclosure part of it. All right, let me see if I can get to it now. All right, point number 8 on page number 5. Point number 8 on page number 5. So financial instrument disclosure, why are they important? Recognition and measurement alone is insufficient. All right, it requires disclosure to allow users to understand something, the risk exposure, changes in risk from time to time, and evaluating estimation uncertainty. So the key risk disclosure, exposure to credit risk, gross carrying amount, where are the credit concentration, what are the collateral held, and the ECL methodology. What is the input on your ECL and the assumption, which is what we talk about the probability of default, etc. Where are the credit considerations? Sorry, what are the estimation techniques? All these three that we use, the probability of default, the loss given default, and the exposure default. All these are the assumption estimation techniques. And what are the forward-looking factors that we use? All right. And this is the reconciliation of the loss allowance. Opening, increase due to credit deterioration, the write-off, and the closing loss allowance. So the teaching emphasis here is link the movement to external economic event. This is very, very important. Don't use a standard explanation. Sometimes they call it boilerplate. This is the last session for today. Then we will look at some of the issues that are brought up in the pre-reading material, and then we will close for today. So this is about hedge accounting that we are going to look at. All right, financial instruments on hedge accounting. I sincerely hope my slides are moving because I moved from the other, Word file to now. I think they are moving. If there's any, please let me know. All right, so talking about, all right, hedging relationship. Some file here missing, is it? Hedge item. Looks like a number 1 seems to be Well, maybe I put a number wrongly. There shouldn't be a number here. All right, hedging relationship. When we talk about hedging, is actually to compensate a fall or a rise in the value of an item that is valued through the profit or loss. Now, this is to what we call equalize the profit from time to time. Because if you buy something in a foreign currency, I give you an example, off the cuff example. If you have, what would I say, an item where you bought from US, a piece of machinery from US, and is going to be manufactured and then shipped to you in Malaysia according to your specification. So let's say the machine is going to be costing US 1 million. And let's just say for simple purposes, the currency rate is 4 ringgit to the US dollar. Make it round figure, right? So therefore, if you went into a situation where last year on the 1st of October, you ordered this machine when it was 4 ringgit to the dollar, just assumption. So you committed to pay US 1,000, so 1 million ringgit when the machine is delivered to you. All right, you're given the guarantees whatsoever. So when the machine is delivered to you 6 months later, let's say in 31st March of this year, all right, you are going to pay 1 million US dollars. Now, let's just say that if the currency went up, that means to say our Malaysian ringgit strengthened against the US dollar, let's say it came to 390, you would have made a profit because you will be paying less. But let's say if the Malaysian ringgit weakened against the US dollar and you are going to pay $4.10, in other words, you're instead of paying 1 million US, you're paying not 4 million ringgit Malaysia, but 4,100,000. So you are undergoing a loss of 100,000 due to the currency. All right. So you want to hedge this 100,000 loss. So you go to a bank and buy a forward currency exchange to be payable that you buy on the date of the transaction or just after the transaction, which is about the same rate. And you say that I'm going to use this currency on 31st March of next year. I'll pay now for it. So whatever you pay now for it, of course, when you have this kind of hedging, the bank will charge you a bank commission or a bank charge. So if the value goes up or down, if you lose money, the bank will top up the difference, pay direct to the creditor, all right, the US company. If it goes down, goes below, the bank gains. The bank takes the gain. All right, you will have to pay the still same full amount because you're committed to paying 4 million ringgit. So this will be called a hedging situation. All right. So a hedge item is the machinery that is required to be hedged, and that will be the asset or liability or a firm commitment or highly probable forecast transaction that you are hedging, right? So the hedging instrument will be the derivative that you buy from the bank. That is called the hedging instrument, all right? Now, so technically, the meaning of hedging is entities engage in hedging activities for what purpose? All right, to manage the risk of fluctuation, either due to fair value fluctuation or currency fluctuation or investment in a foreign subsidiary. So I gave you the example just now was investment in an asset, right? So investment in an asset, and so the asset is bought in foreign currency. So hedging against a foreign currency movement, you want to hedge it. So common example, entering into a forward contract to manage exposure to exchange rate movement or use an interest rate swap to manage exposure to interest rate movement. I will explain interest rate swap in a moment. Though some entities will be involved in more complex hedging transaction. So when an entity enters into a hedging transaction, it uses two things: the hedging instrument which is the document with the bank, otherwise known as the derivative. It derives its whole existence from the hedged item, which is exposure to the hedge item. So in our example where we bought the asset from US to be manufactured and delivered to Malaysia, that is an asset. All right. But that asset is tied to a currency. And the currency is the US dollar. And there is a currency risk that the US dollar can appreciate or depreciate against the ringgit Malaysia, which means that if the currency appreciates, you're going to pay more. If the currency depreciates, you're going to pay less. All right. So if the Malaysian ringgit strengthens, you are going to pay less. If the Malaysian ringgit weakens, you are going to pay more. So that's what it means. So in order to avoid yourself from paying more or less, you take out a hedging instrument with the bank, which is the forward exchange purchase of currency. And then the hedge item is the machinery purchased from US. So this will hedge the currency fluctuations here. So this is called a currency hedge. So a hedge item is something that exposes the entity to the risk of a change in the fair value, a risk of a change in the fair value, and that fair value can also affect the P&L account. Or it could be a risk of a change in the future cash flow. So my example I gave you was a future cash flow. When the machine arrives in Malaysia, you are going to pay more, right? So an example, a loan with a variable interest rate, right? You got a loan, but the interest is not fixed, is variable, all right? Or a highly probable forecast transaction in a foreign currency or a net investment in a foreign operation. These are simple examples. I'm going to explain some of them to you. So a hedging instrument is a derivative, such as a forward contract or interest rate swap that mitigates the risk associated with hedge item. So certain non-derivative financial instruments may also be hedging instruments. All right, we don't worry about that. For example, a foreign currency loan carried at amortized cost may be used to hedge foreign currency risk. The idea that gain or losses on the hedging instrument will be offset, right, to varying degrees, gains or losses on the hedge item. So gain or losses on the hedging instrument will offset, not 100%, but to a varying degree, almost. It offsets the gain or loss on the hedge item. The hedging instrument, the derivative, will set off against the hedge item. Our example, the machinery is a hedge item. So currency fluctuations there will be offset by the hedging instrument where we bought forward currency. All right. So under normal accounting rules, the gain and loss of the hedge item and the hedging instrument can end up being recorded in the profit or loss in different accounting periods because you pay at one time, you accrue it at another time. So there will be changes in the earnings, and that will have your volatility in earnings as the currency goes up and down. So hedge accounting was set up for the purpose of setting these rules, accounting rules that will be applied if certain criteria are met and allow the gain and losses on the hedge item and hedging instrument to be treated differently in order to achieve a better matching. Remember, you don't need to go very detailed into hedging, all right, because hedging is an actual practical thing. And some companies do, some companies don't do. But you need to understand the basic principle. That's what the students need to understand. Why do you ever have a hedge accounting? What is it for? What does it do to the balance sheet and profit and loss account? What does it do to a cash flow? That's what the questions that they need to understand. All right. So special hedge accounting rule that may be applied if certain criteria are met allow gain and losses on the hedge item and the hedging instrument to be treated differently to have better matching. So how differently is different? So the specific treatment depends on the type of the hedge. Sometimes hedge accounting will not be necessary because it may not affect the profit at all because the value fluctuation is so little. Like short-term hedges do not cross a reporting period. So within 1 year, all right, fluctuations will automatically go into the account. You don't need to do hedging. It's only when it cross over a balance sheet date, then you can get, floating loss or floating gain, which will be offset with a hedging floating loss, hedging floating gain. So that will square it off, right? So the objective of hedge accounting is to represent in the financial statement the intended impact of the entity's risk management activity, intended impact of what the company is doing to manage the currency and the fair value risk. What are you doing? Because you have a currency risk or a fair value risk, right? Now, let me give you a fair value risk example. Let's say you invest in a bond, right? And the bond is for 6 years. So bond is quoted on the Bursa Malaysia. So now this is treated as fair value through profit or loss. So at the end of every year or any quarter or any half year, the fair value is the Bursa market value. If the value of the bond happens to have dropped in that year end, for whatever reason, economic reason, etc., whatever, and then what will happen is because the amount shown, let's say in the balance sheet, investment in quoted bond, 1 million. At the end of the year, the bond has gone down by 200,000. Is only now fair value 800,000. So there's the 200,000 missing because you must show bond at fair value 800. So 200,000 goes to the P&L account. So the P&L takes a hit of 200,000, not because you actually lost the amount, but simply because the fair value of the bond went down. Now, maybe the fair value of the bond will reverse back in the next 1, 2 years. All right. There could be circumstances in the current year that cause the bond value to fall. Maybe because of interest rates or things like that. As you know very well, bond is very sensitive to interest rate. When the market interest rate rises, the bond value will fall, right? When the market interest rate falls, the bond value is rising. So what then is the market interest rate? Is the Bank Negara's rate. Let's look at this. If Bank Negara increases the interest rate, right? The bank interest rate, then everybody will then say, oh, I better put my money on fixed deposit because the banks have also increased their interest rate. So now I can get a better rate of fixed deposit. May not be as good as a bond, but if I want security, if I'm a very risk averse person, I want to have proper security, I put it on fixed deposit. All right, I get a much better interest rate. So because the value is right, that's risen. Now, if I was a bond investor and I invested in the bonds, and the bond is carrying 6%, interest. Maybe it's a some kind of bond that is a good bond, 6%. Now, bank interest has gone to 4.5%. So I'll be wondering, every time I put my money in the bond, I'm getting 6% or 6.5%, but every night I can't sleep. What if the company closed down? What if they face an economic situation? What if their goods cannot be sold? What if there is tariff on their company? Then my bond becomes nearly worthless. So I have sleepless nights, although my interest is higher. So I say, all right, I will liquidate my bond and put on the fixed deposit. So when I start to liquidate, others may also be liquidating. So bond value on Bursa Malaysia will drop. Why? Because interest rate has gone up. Correct? Now, what happens the other way around? If the government says, all right, we want to stimulate the economy, want economic growth, we don't want to have stagnation, etc. So we bring down the interest rate. So more money flows out of the banking system into in the form of loans, etc. And more money is available in the economy. So interest rate goes down. Fixed deposit rate also goes down. So people who have fixed deposit are gone down to 3%, 2.9 IER. This kind of figure not nice to see. Lah. So they will liquidate their fixed deposit, look for other places of investment, maybe in shares, maybe in bonds. So they say, all right, why not? The bond is 6%. This is only 2%. I might as well invest. I take a bit more risk. I invest in a 6% bond. If I want higher risk, I will invest in a 7%, 8%, or 9%. The higher the percentage, the higher the risk. So, how is my risk situation? Am I a risk taker or a risk averse person? Somewhere along the risk averse to risk taker, somebody will be along that. So somewhere along that graph, if you are a risk taker, you will go for 8%, 9%. If you are a risk averse, then you might just say, all right, I may go for the 6% bond. So I begin to buy up. So bond value rises. Market interest goes down, bond value rises. So that's the principle. Now, where does hedging play a role here? So a company has invested, as I told you just now, 1 million in bond. The market value has dropped to 800,000. The P&L is going to take a hit of 200,000. Now that's not very nice. People say, "Hey, why this company's profit this year going up, that day going down, next year going up like this? No good, lah. This company will, it's not good." So you also don't want to show results like that, right? So you want to want to negate the effects of that 200,000 loss. What do you do? All right, what do you do? So you are going to buy uh, a derivative, and that derivative is called an interest rate derivative. All right, remember I told you just now interest rate derivative. So this is sometimes called, taller or things like that. There are many terminologies that you use on this kind of interest rate, which I mentioned just now to you, the interest rate risks that you manage. So what I do is I go to the bank and I say I want to buy an interest rate derivative. So that interest rate derivative means that I have to show I have a bond here, 6% bond. The value is at this price. I bought it. So I want to, check on the fair value movements. So when I get this interest rate derivative, what the bank is in fact doing is charging me a fee to cover any loss. And if there's a gain, they will take the gain. So in other words, I have a derivative in the accounts now, an interest rate derivative. So this interest rate derivative will now be shown as a gain because the bank is going to cover my interest. So whatever is going down is going to get covered here by the interest rate rise. So because of the interest rate rise or the interest rate low, that difference of 200,000, maybe 180,000 will go to the P&L account. I got a loss of 200, I got a gain of 180,000. So my net loss in the P&L is only about 20,000. So I've reduced the impact of this interest rate, risk by way of a derivative. And so my P&L will not show a 200,000 loss, but maybe a 20 or 18,000 ringgit loss. All right. So that is an interest rate derivative. And rather, which is what should I say, to to negate the effects of fair value changes. All right. Earlier, I told you was currency risk. So let's go through here. So the objective of hedge accounting is to represent in the financial statement the intended impact of the entity's risk management. Here, I am managing the risk of loss. All right, when financial statements are being used to manage exposure from particular risks that could affect the profit and loss, exactly what I did. So in the case of a fair value through OCI, equity investment, or other comprehensive income, all of these risks can be managed. So a hedging relationship. What is a hedging relationship? So an entity may choose to designate a hedging relationship between the hedge item. All right. In our case, the bond is the hedge item, and the other one is the machinery purchase is the hedge item. And the hedging instrument is the derivative that I go to the bank to get a currency forward exchange, and I go to the bank for interest rate risk. All right. To manage interest rate risk, I'm buying a hedging on the interest rate risk. So this will be what we call the hedging instrument. So MFRS 9 includes detailed requirements regarding which item can be hedged and which instrument qualify as hedging instruments. So there are three major type of hedge. A fair value, which I just mentioned, where the fair value of the bond going up and down will be automatically controlled by the instrument. When the fair value goes down in terms of the bond, which is the hedge item, the instrument that I hedge will go up. When this goes down, it goes up. So either way, the balance sheet or the profit and loss account will not take a big hit at all, right? So same thing with a cash flow hedge. Hedge of a net investment in a foreign operation, which I'll explain shortly. So a fair value hedge. So fair value hedge is the bond just now, is a hedge of the exposure to changes in the fair value of a recognized asset. Investment in a bond is a recognized asset, right? Or a liability or a firm commitment or a component of any item that are attributable to a particular risk that could affect the profit or loss. So the hedge item is an equity instrument, like for instance, hedging in shares. Then that the entity has elected to classify and measure at fair value through other comprehensive income, the hedge exposure must be one that affects the OCI. So what does this sentence mean? So I bought a share for a long term. So I've designated as fair value through other comprehensive income. I do not wish to sell the share in the short term. I am going to leave it there for a longer period of time. And so I don't want it to affect my P&L account. So then I will also have, I don't want to affect also the other comprehensive income. And so I want to hedge that same share. So if the share makes a loss, my hedging instrument will create a gain. All right, because it goes opposite of the principal item. So that gain will go into OCI. That gain cannot go into P&L because the principal the principal instrument, which is the shares, is been designated at fair value through other comprehensive income. Remember, you have a one-time irrevocable option to put it into the other comprehensive income. So it is not, that you have to follow. It goes instrument by instrument. You can decide each instrument. This one I want to go into fair value to profit and loss account. This one I want to go fair value through OCI. So you can make that decision under MFRS 9. All right. Now, example of a fair value hedge. Let's say this company, Apex Equity Fund, issues a 3-year bond with 7% fixed interest payments. All right, it's a 7% bond. The fair value of this instrument will vary as the market interest rate goes up and down. If the market rate increases, that means that the government increased the bank interest rate, the value of the fixed date debt instrument will fall. If this goes down, that goes up, right? So this is called, on the same day, Apex enters into an instrument to what should I say? To avoid the profit and loss going into the P&L. So one side loss, one side will be a profit. So we have a fixed to floating interest rate swap. You are swapping the fixed interest rate of the bond with the floating interest rate that the government has done it, all right? Floating interest rate that the government has done. So when the government puts the interest rate up and down, right? That's floating. So you are converting a fixed bond into a floating. So that's called interest rate swap. It's a derivative, meaning this will effectively be paying a variable rate on the debt rather than the fixed rate on paper. So this is done in order to hedge against movement in the fair value of the debt. So bond goes up and down, movement, right? That will hedge against the respective interest rate risk, any gain or losses arising in the movement due to gain or loss, all right, will be offset by almost equal, not exactly equal, almost equal and opposite gain. One loss, one gain. All right. So on the interest rate swap. The downside here is the more accurate you want your swap or more, then you pay a lot more on bank commissions. All right, bank on that particular hedge. So if you want just to be about 10 to 15% different, the rest you want to 80%, you want to offset, then you don't have to go 100%. Then your commission may be less. All right. So under normal accounting rules, the bond, which is the hedge item, the bond, would typically be measured at amortized cost because it's a bond, with gain or losses relating to movement in the fair value recognized in the profit and loss if the bond was early settled and sold. Right? Now, if you use amortized, it won't have a fair value, only when you sell. But if you use fair value, then there is a fair value. So bond can be carried at amortized cost. It can be carried at fair value, provided the bond is quoted. The bond can only be carried at fair value if it is quoted. All right. And so the swap, the hedging instrument, otherwise known as interest rate swap, right? On the other hand, would normally be measured at fair value with the gain and losses recognized in the profit and loss. So the swap is a derivative. So that derivative only exists as long as the principal asset is there for it to hedge. If this is sold, hedging no more already. All right. So this results in an accounting mismatch and a volatility in earnings because the loss on one side is a floating loss or gain on the hedge item, and the hedging instrument will be recognized at different times, potentially different period. So by applying the optional fair value hedge accounting rule, both the hedge item and the hedging instrument are measured at fair value through profit and loss. So usually when you want to do a bond, you will not use amortized cost. All right, you will use the bond at fair value as long as it is quoted. If it's quoted, you can do it. If it's not quoted, then you will have to use this amortized cost. Gain or losses in the fair value only when it's settled earlier. I mean, you sold the bond early, then you will make a gain or a loss. All right. So the swap for this item, which is amortized cost, would normally be measured at fair value, and losses will go into P&L. One is at amortized cost. The other one is at fair value of the same bond. Now, then the fair value will go to P&L account. This will be an accounting mismatch because you got fair value changes going to the P&L account, but the bond is fixed at the amortized cost, right? So this will result in accounting mismatch, and there will be also volatility in earnings because the gain or loss on the hedge item, which is the bond, and the hedging instrument, which is the derivative, will be recognized at different time and different accounting period. So that will not be the best thing to do. So the best thing to do is to match it on both sides. So for a fair value hedge, use a fair value bond. All right, applying the optional fair value accounting rule on both the hedge item and the hedging instrument are measured at fair value through profit or loss. The outcome is that the gain or loss on the hedge item, so the hedge item is the bond and the hedge instrument is the swap, are matched in the same profit and loss in the same period. Bond value go down, the hedge go up, so in the same period. May not be exactly the same figure, but it will be there. All right. So next one will be, of course, this results in the accounting reflecting the underlying economic of the hedge and avoids volatility in earnings that goes up and down because of fair value changes. So this is a fair value that is actually on a instrument, and this fair value derivative is called interest rate swap. They got interest rate swap, they got interest rate collar, and a few other kind of terms. They are all, to actually contain fluctuations in this sort of fair values. All right. So we won't go into all that collars and all of that because actually they don't need to go into all of that in terms of just to understand hedging. Hedging is an important point to understand. Otherwise, people say, have you hedged the thing? Hedge what? Right? So, what do you mean by hedging relationship? Now, a cash flow hedge, like I mentioned to you just now, a cash flow hedge is actually a hedge that you will uh, cover the risk of paying more cash than you should be paying. Like the machinery imported from US is subject to a cash flow risk. So you want to mitigate that cash flow risk. So let's follow this. The cash flow is a hedge of the exposure to variability in the cash flow that is attributable to a particular risk, currency risk, associated with all or a component of a recognized asset, the asset we purchased from US, or a liability, or a highly probable forecast transaction. Now, liability and highly probable forecast transaction don't have to go detail into all of this. They come very, very complicated. All right, when you're talking about highly possibly forecast, probable forecast becomes complicated. Liability may become complicated, but not so complicated as a highly probable forecast that could affect profit or loss. So let's look at a cash flow hedge example. Tenaga Manufacturing, Berhad, has a functional currency of ringgit Malaysia. It is expected to have sales of US 1 million in December 2023. All right, got sale of 1 million in US dollars. To manage the exposure to exchange rate movements, it enters into a forward contract today. All right, the day on which this thing transaction is done. All right, to sell the US dollar for a fixed amount of ringgit Malaysia in mid-December 2023. So doing so gives Tenaga greater certainty over the ringgit Malaysia revenue because don't forget it's sold at US 1 million. So if on the date of sale in December, 1 million is 4 ringgit, you should get 4 million ringgit into your account. But if the US currency strengthens, you will get less. If it weakens, you will get more. So you don't want to go into the risk of whether you get more or you get less. You want to be certain with your profit and loss account. You don't want to take the risk. Of course, everybody wants more. But the thing is that what is the risk that it will become less? So to avoid this is where you go into cash flow hedge. All right. So doing so gives Tenaga a greater certainty over the ringgit Malaysia revenue and the cash flow, as any gain or loss arising due to the movement in the ringgit Malaysia of the expected sale, the highly probable forecast transaction, you expect to get currency, right? Should be offset by broadly equal and opposite gain and loss on the forward contract, the one that you are actually buying forward US dollars. So the cash flow hedge is a hedge on the exposure to the variability in cash flow that is attributable to a particular risk. What is the risk? Currency risk. The risk that the currency will fluctuate up and down, associated with all or a component of a recognized asset, which is in our case here, that is the sale. All right. So sale is a receivable. The receivable is the asset or a highly probable forecast transaction that could affect the profit and loss account. All right. So that's where we went through this example. Did I? Yeah, went through the example. And so we came up with this broadly offsetting the risk. Now, under normal accounting rules, a highly probable forecast transaction, the hedge item, would not be recognized in the financial statement until the sale is made. All right. So if you are actually taking up a sale, now let's look at the sale again. Uh, where's the example? All right. So Tenaga, as a functional currency, it is expected to have a sale of 1 million. Forecast transaction, not yet make a sale. It is expected to make the sale in December 2023. And hence, you get this highly probable forecast transaction. It will not be recognized in the financial statement because no sale yet. You are going to make a sale, all right? But you're worried about the currency fluctuation. So meanwhile, the forward contract, the hedging instrument, will normally be measured at fair value with the gain recognized in the profit and loss account. So then this will result in accounting mismatch if you buy the hedging transaction first before you actually do the sale. Right? As the gain or losses on the hedge item and the hedging will be recognized at different time, potentially in different accounting periods. So by applying what they call optional cash flow hedge accounting rule, the gain or loss on the hedging instrument, instead of going to the profit and loss account without the actual sale taking place, park it in the OCI until the hedge item affects the P&L. Until you make the sale and the hedge item of the sale, currency changes, goes to P&L, you transfer it into P&L. In other words, the mismatch of taking up the OCI, a mismatch of taking up the hedging transaction, the movement in the hedge must go to the P&L account. Instead of putting the P&L, put it in the OCI until the sale is made, because this is a forecast sale. All right. It is expected to have a sale. It's called a forecast sale. So if you don't have a sale, there is no currency change. But you want to lock in this 1 million now. All right. So that you know that you will get back that money. So you go into a hedging relationship before the sale is made. So at 31st December, there will be a change in the value of the hedging contract. All right. The derivative. So that derivative will go into OCI. All right. It'll be measured at fair value. Sorry. It will measure at OCI. It goes the hedging instrument to apply the optional cash flow hedge accounting rule. The gain or loss on the hedging instrument goes to other comprehensive income until the hedge item is made. That means the sale is made and it affects the P&L. The outcome is that the gain and losses on the hedge item and the hedging instrument are matched in the P&L in the same period. Because before that is parked somewhere else, then it goes to P&L. This results in an accounting reflecting really the economics of the hedge and avoids volatility in earnings that will otherwise happen. You sold in US dollars, but you get Malaysian ringgit instead of what you should be getting in December, you get in January much less or February much less when the payment is made. So you want to avoid that less due to currency risk and currency fluctuation. Hedge that currency risk and the fluctuation with a cash flow hedge. Okay, again from the bank. So this will not happen. Now, what about hedging of a net investment in a foreign operation? So you may have an investment in Indonesia. You have a company in Indonesia and you have invested shares in that. All right. So when you actually convert every end of the year to consolidate with the Malaysian accounts, you will have differences in the foreign exchange rate between the Indonesian rupiah and the Malaysian ringgit. Let's say, for example. So you don't want this fluctuation in the rate to affect all your assets and liability. So you hedge the reporting interest in the net assets of the foreign operation. So interest in this subsidiary, you will lock it, and so it will not fluctuate. Changes in the value goes to P&L account. Next year, changes goes to P&L. Your P&L is going up and down, not because the subsidiary in Indonesia is not making money or whatever. It's because of the currency changes, all right, that is happening. Just like recently, the Indonesian rupiah fell. All right. So if that was the one happen, your investment suddenly will fall. And for what reason? All right. Really is the value. It's not a short-term investment, it's a long-term investment. So this kind of short-term currency changes, you don't want it to affect the P&L. So, so you call it hedging of the net investment in a foreign operation. So example of a net investment in a foreign operation, let's say Gunung Corporation, Berhad, a Malaysian company, short form Gunung, whose functional currency is Ringgit Malaysia, has an Australian subsidiary whose functional currency is Australian dollars. So in order to finance this investment, it borrows Australian 100 million from a bank. Remember, it's investing in Australia. So you must borrow Australian dollars to invest. You can't borrow Malaysian ringgit, convert it and put it. It's terrible. The loss will be one hell of a thing. And the bank charge will be another story. So you must be able to borrow in Australia in Australian dollars from the bank, 100 US dollar, Australian dollars. So Gunung does this so that any decline in the value of investment due to the foreign currency movement will be matched by a decrease in the cost of funding that investment because you're borrowing in Australian dollars, right? And therefore matched by a decrease in the cost of funding that investment. Any gain or loss due to the movement in the fair value of the net investment will be set off against the gain or losses on the loan, the currency gain or loss. All right. Movement in the fair value of that investment in Australia will be matched against the movement in the loan because the currency is what is making the loan and the investment different. So automatically it is, matching each other and setting off. So under normal accounting rules for consolidation, Gunung's interest in the net asset in Australian subsidiary, which is the hedge item, would be translated to ringgit Malaysia on the balance sheet date using the closing rate for the assets and the liabilities and the average rate for income expenditure P&L item, use average, balance sheet, you use the closing rate, right? That is the normal conversion of foreign currency. So any gain or losses would be recognized in the profit in OCI and accumulated in equity. All right, so it goes to OCI because it's a long-term investment, and then it goes into equity. Meanwhile, the loan, which is the hedging instrument, will be translated to ringgit Malaysia on the balance sheet using the closing exchange rate between the Malaysian ringgit and the Aussie dollars. Any gain or loss will go into the profit or loss account. All right. So this will result in an accounting mismatch because one is in OCI, one is in P&L, and volatility in the earnings as the gain or losses on the hedge item, all right, is being taken up in the OCI and the hedging instrument is recognized in the P&L, right? So by applying again optional hedge of a net investment in a foreign operation accounting rules, the gain or loss on the hedging instrument is taken to a separate foreign currency translation reserve also in the equity. All right, instead of going to P&L, goes into the equity. So both goes into OCI. The cumulative gain or loss then reclassified from equity to profit and loss at a time when you eventually dispose of the Australian subsidiary, then it will go back into the P&L account, right? So that outcome is that the gain and losses on the hedge item and the hedging instrument are matched in the profit or loss in the same period, right? So now you are going to put it both in the same period because you're going to OCI. So this results in accounting reflecting underlying economics of the hedge and avoids the volatility of earnings. So remember, just now also we had this thing. One goes to P&L, one goes to OCI. All right. So in order to do it, use the special accounting rules. All right, that you are required to use. All right, and that is the accounting mismatch. Use the optional hedge of a net investment. Optional. Right. Same thing. We're just now also optional. If you use that, both will go into the same. Then you need to explain in the notes on the account that you use the optional hedge accounting rules in order to match it. All right, that you need to do. Okay, now we have not come to the end of the webinar yet. So we will now look at all the notes that I've given you. So I don't need to come back to this. So I think I can stop sharing and safely go into your pre-reading notes. All right, to see whatever we have not covered, we will be looking at the pre-reading notes. I hope that the pre-reading notes don't affect the movement of the slides, the movement of the pages. All right. Let me know if the page does not move. If the page is moving, then you don't have to say anything. All right. If the page is not moving, let me know. Then I do that. Now, there's a question there. Let me answer it. What is an unrecognized firm commitment? How is it considered a fair value hedge? Now, if you have a firm commitment to purchase something, all right, and that is to purchase a bond or something like that, because only bonds and things that have fair value, that will be unrecognized firm commitment, means you intend to purchase the bond, but you have not yet purchased the bond. So if you want to buy a fair value hedge from the bank with the intention to purchase the bond, as what we said just now, there is a firm commitment to purchase, but it's not yet recognized in the books because you have not bought it. A commitment to purchase does not mean the bond becomes on the balance sheet. But at the same time, when you have that commitment to purchase, you don't want the bond to be fluctuating. So you go into a derivative now, all right? And this will be the interest rate swap. So the interest rate swap is the fair value. So whenever the interest rate goes up or down, all right, due to the interest rate changes, the fair value of the bond goes up and down. But it has not yet started. So you recognize the fair value hedge that you bought, which is the interest rate swap, in the accounts, and you will park it in the OCI. All right, goes to OCI. So now, when you buy the bond at fair value, eventually it goes to P&L. Fair value goes to P&L. That becomes the mismatch, all right, between the firm commitment, which now has eventuated into an actual purchase, and the derivative that you bought, which is a fair value hedge. So now you are going to have the special rules apply to bring both of them either into the OCI or both into P&L, depend on where you want it. So if you have intention that the bond is not going to be, you may sell the bond along the way, then you will treat it as fair value through profit or loss, and the corresponding changes in the fair value is controlled or controlled by the interest rate swap, because interest rate up and down changes the fair value of the bond. So this interest rate swap will control the fair value. When the bond value falls, the fair value goes up. So these two will set off against each other, not 100%, but substantially. So you will have that. So that is called an unrecognized firm commitment to purchase a bond, and then you buy a hedge to contra the impact of the bond when you actually purchase it. So it is a firm commitment. You cannot say to the bank, I want to buy, I think of buying a bond. Can I have a fair value hedge or a interest rate swap? The bank will say no until you give a firm commitment. You have a document to show you are buying this bond, right? Then I can, based on the bond, give you a derivative, which is the interest rate swap, and you will pay the bank commission from then onwards. Of course, no company is going to be stupid to just pay a bank commission when you don't intend to buy this. So this is a firm commitment, but not yet materialized, in the sense that the bond has not been issued. Maybe it's undergoing, Bursa Malaysia and Securities Commission approval along the way, but you have already given a firm commitment, I'm buying this bond. All right. So that is what they call an unrecognized firm commitment. And the fair value hedge is the corresponding hedge that you buy from the bank as a derivative. Right? Then you will have the mismatch. Then you got to address the mismatch as well by using the special rules. I hope I answered your question, Dr. Wee. All right. Now, if everything is okay, let's round up today's session by having a quick look at this. If anything is extra here, I will go through. All right. So most of them, I think you have already shown this. You already read this, so I don't want to go through anything that is not distinct, but I want to go through something here to just highlight what we did this morning. This is like a revision, all right? So maybe I won't start from the beginning. We will start from why MFRS change impairment accounting, all right? The problem with the old ISA 339, IAS 39, called the incurred loss model, which is what we always did, provision for bad debts, actual bad debt. So credit losses were recognized only after a lost event occurred. Today, we are not talking about lost event occurred. We are talking about a future lost event. So this resulted in delayed recognition of loss, overstatement of assets during economic boom, right? Overstatement. And then sharp write down during downturn. Downturn, everything cannot be so we write down, write down. But when there is a boom, don't write because not yet incur a loss. So that's where I mentioned earlier this morning, the 2008 global crisis exposed this weakness because investors said, how come if this set of accounts are properly done, should not they have taken into account a potential loss in the future in the economy? Or is it that everything is historical? And that caused the standard to be changed. So they came up with MFRS 9 response, a forward-looking model, no more on historical. So introduce expected credit loss, and that means we anticipate losses. Don't wait for default. Anticipate it. That's a huge difference. So anticipating is, you can say, guessing. But can you simply guess in a financial statement? No. That's where all the probability of default, etc., came into being, to have a structured way to approach it. For forward-looking and macroeconomic information, not micro but macro. So the core principle was recognize a credit loss based on expectation, not an event, not a lost event. So expectation is where we are looking expected credit loss. So the expected credit loss is the probability weighted estimate. Now, I said we are not going into so much detail because these will be too complicated to, to do in an examination. But you must know it could be probability weighted. The higher probability, the higher the weighting. How do you match the probability and weighting? Very complicated. I can show, but it will take a lot of time. Right? In fact, I have the notes for them. But the thing is that I don't think you need to go for that. Right? So that's where I said, don't have to worry. And then the credit loss, the present value of the cash shortfall, right, will be the present value is the credit loss. So remember, every time we look at an expected, you have to discount it to the current. All right. So instruments that are subject to expected credit loss, trade receivable, you only take lifetime, not 12 months. All right. And contract asset, lifetime, not 12 months. Others like loan receivable, we talked a lot about. That instrument measured at amortized or at fair value to OCI, loan commitments, financial guarantee, all this you will look at expected credit loss. So we also talked about the three-stage model, impairment model or ECL. So stage one is a credit quality and the ECL, when is it recognized and how the interest is recognized. So stage one is a performing loan. All right. Even though it's performing, you must do a 12-month expected credit loss. Apart from debtors, loans, yes. Trade receivables and leases, no need to do 12-month expected credit loss. You only need to do for other loans. All right. So you carry a 12-month on the gross carrying amount of the loan. Stage two is significant increase in credit risk. All right. Credit risk. That means the risk is they are delaying the payment. When you delay a payment, it is not a default yet. You delay. So, but the credit risk is increasing, as I mentioned, to a bank. Why are you delaying? You probably have some financial problem. So to the bank, they want to manage their risks. So they say, oh, this is a significant increase in credit risk. Now we will do a lifetime expected credit loss. And all this, you have to use the probability of default, the loan given default, and the exposure at default. You have to use all that formula. You cannot just come up with what is the lifetime. I think I plucked out of the blue. So third one, of course, is credit impaired. Really defaulted on some payment, interest cannot pay, then becomes a lifetime expected on the net carrying amount. What is the net carrying amount? Right? Here again, you need to use the three formulas. All right. The probability at default and the loss given default and also the exposure at default. You need to know that. Otherwise, this net is not just the net carrying amount. All right. So stage one performing asset has not experienced significant increase in credit risk, a recognized 12-month expected credit loss, whether you like it or not. This does not mean losses expected only in the next 12 months. It means losses arising from defaults that are possible. It may not happen, but you are ahead of things. You make it possible within the next 12 months. Stage two, significant increase in credit risk or a deterioration in the credit risk. So here is a very judgmental area. So things like breach of a covenant. Your current liability has gone higher than your current assets. Your profit is not what the bank requires. Your equity and your borrowings to equity ratio has already breached the limit set by the bank. So you have broken your covenant. So that becomes significant increase in credit risk. All right, or a deterioration in the credit rating of the bond, of the investment, of the loan. Adverse changes in the economic outlook, economy outlook. The macroeconomics comes in here. Payment more than 30 days past due. Now, here, as I mentioned, rebuttable, right? If you actually deliberately pay 30 days past due, there is no rebuttable presumption. Let's say the money was supposed to come in. You have a standing instruction with a bank to pay on time, your bank and another bank which receives this. So the standing instruction probably was not executed, or the bank was undergoing some, upgrading of the software, was not executed on the date, but a week later. So does that mean that payment more than 30 days becomes a risk? No, it's a rebuttable presumption. It's rebutted not because payment could not be made, but the banking system had a problem. Okay, so that is rebuttable. Now, key point for all of y'all what our education is, stage two does not mean defaulted already. It means the risk has worsened, not yet default. Risk has worsened. All right. Stage three is when it is really a default. Credit impaired assets. Indicators will be a default, significant financial difficulty of the borrower, restructuring because of credit problems, or probability that the company may go bankrupt because liabilities are much greater than the assets. So at this stage three, interest revenue is calculated only on the net amount. Lifetime expected credit loss continues to be recognized. It may be increasing. So you have something called the simplified versus the general approach. Simplified is trade receivable and lease receivable. You can cut them out of it, contract assets as well. You only use lifetime expected credit loss. Don't use the 12 months, okay? More complicating. So key features, no staging. Staging means going from stage one to stage two to stage three, receivables and leases, contract asset, no need to do that. Only recognize lifetime expected credit loss, commonly applied using a provision matrix. All right, now this is a matrix that is done by companies as well for the debtors. So we use that kind of matrix. All right, how many days? Let's say you're 30 days, you may have a 0.5 provision. All right, if it's 31 to 60 days, you already delayed that, then you may go up from 0.5 to maybe 1% or 2% of your debt becomes a provision because you have defaulted a little bit, you have extended. You still will pay, but you dragged that kind of provision matrix. All right. And then moving down, all right, the practical illustration on a trade receivable. So this one you didn't see in the slide. We'll look at it here. So aging, amount, and the loss rate. Current, you have 700,000 due on your receivable. You're not going to do a lifetime. You're only going to do, but you're not going to do 12 months, sorry. You're going to do lifetime. So current is 700,000. The loss rate is 1%. All right, this is your estimation. Now, once it passed 31 to 60 days, your matrix will show you 5%. That matrix is a management judgment. All right, you will do it based on your experience of debtors in your company. More than 60 days, all right, 100,000, that will be a higher risk, 20%. So this is a current on 700, 1%, 31 to 60 days overdue already, you take 5%, more than 60 days, you take 20%. So your expected credit loss, which is the lifetime expected credit loss, you take 1% of 700, 7,000, 31 to 60 days, 200,000 already overdue the 30 days. So you take 5%, which is 10,000, 60 days, 100,000, you take 20%. So you'll be creating a 37,000 provision for lifetime expected credit loss. So the total ECL will be 37,000. We need to emphasize something here. Loss rates are always forward-looking. So this will change if the economic factors also change. All right. So this is not cast in stone, but it is changeable. Right? It's not a purely historical average. It does not rely on history. It relies on the forward. That makes the whole world of difference between ECL and the olden days incurred loss. Right? General approach for long-term receivable. Now, if you have a loan and long-term receivable, then it's used for loan receivable, debt instrument like bond. It requires staging, stage between stage 1, stage 2, stage 3, depending on your credit risk. All right, whether there's a significant increase in the credit risk. You always use forward-looking information. So the standard explicitly requires incorporation of reasonable and supportable forward-looking information. One more important thing, without undue cost or effort. Don't go and do a massive research and try to look for supportable information. Look at the general. All right, that's what you need to do. So things like what is general? Your GDP growth, your unemployment trend. Remember, we did one example just now. The interest rate outlook, whether it's increasing or decreasing, the industry specific risk, depending on which industry you're in. So students often think that ECL is purely mechanical. As you can see this morning when we calculated, no way is it mechanical. It is estimation plus the most important judgment. This judgment is based on the probability of default, the loss given default, and the exposure of default. And that again was the whole rigmarole we went through this morning. So common training pitfalls. We should caution against treating expected credit loss as a provision. Oh, I know this is a provision for the future. Don't think of it as a provision for the future. You will get a wrong concept. So do not ask them not to think it as a provision. All right. And don't automatically move assets from stage 2 to stage 3 after 30 days. Stage 1 to stage 2, 30 days, we move to stage 2. Not necessarily so. You must not ignore macroeconomic overlay, the economy itself, the labor employment rate, all these are macroeconomic, and assume a lifetime expected credit loss. We always take the worst possible scenario, make it easy. Whole thing, make a provision. Now, that is not going to show a true profit or true and fair view of the profit, right? So financial instrument disclosure, we also talked about it. You require disclosure that allows user to understand the credit risk exposure, assess the changes in the credit risk. Now, here is where people want to know, all right? If there are changes, which way is the change going? Going favorable or against? Then I make my judgment based on what is given. What if I extrapolate it further? What will happen? so that the user makes the decision. You only give that what you know. Then evaluate estimation uncertainty. So there are estimates and you're uncertain. So tell them that these are estimation uncertainty so people will know whether I want to rely on your estimations or do I think because you have stated it's uncertain, I make my own estimation and come to my own judgment. All right. Now, these kind of things, when you are looking at a company that is going to be acquired by, let's say, a fund manager, all right, foreign investment funds come in to take up some of the companies here, buy a 45% stake or 51% stake, and then expand it by putting in a lot of capital, expand the whole operation, give out dividends to their customers, to their the unit holders, those people who contributed to the fund, and then after 5 years, sell off the whole thing, gain the capital, and then they go. That's what they do. Now, all these are looking at this sort of thing very, very closely because they want to see how it works, right? So when they do a due diligence, these are things that will be done. So you cannot have a set of account due diligence way out from what you actually presented, right? So moving further, key credit risk disclosure requirement. So credit risk will be the gross carrying amount. Where are the credit concentration? What collateral is held? We went through this morning. So the expected credit loss methodology, what are the inputs to the expected credit loss and the assumption? So the inputs will be the probability of default, the loss given default, and the exposure at default. What is the estimation techniques and the forward-looking factors as well? All of this will be considered like we did in the example this morning. If you refer to it, is there. And then the reconciliation of loss, opening loss, increase due to credit deterioration, amount written off, and the closing loss. So one of the things that I want to emphasize is link the movement here to economic events in a note. Avoid standard explanation. Don't put standard wording. Nobody likes standard wording. All right. Olden days, they used to put standard and get away with it. Today, it's not like that. So then the hedge accounting that we covered, this section is basically conceptual. It's not very technical. It's a concept of reducing or managing the effects of a loss or a gain in the P&L account to prevent undue fluctuation. So this is the concept. Why hedge accounting exists at all? Because without hedge accounting, derivatives will be measured at fair value to P&L. Hedge items may not be valued at hedge items to P&L. So therefore, there will be a fluctuation. Result, artificial volatility in the profit and loss account, right? And now, hedge allowing actually aligns the risk management with accounting. So you want to manage the risk of a fair value change or of a currency risk of currency losses. You want to manage the risk. This is the risk management technique, the purchase of derivatives, right? So for hedge type of a fair value, changes in fair value is what you address. So changes in fair value is what we talked about. The cash flow, I mean the what's that? The hedging of the changes in the fair value. All right. Interest rate swap is one of them. And then the cash flow hedge, variability in the cash flow, like purchase of a foreign asset, and then you pay in US dollar. So you don't want the variability in the cash flow. You want to lock it up on the date, so you buy that. And net investment in a foreign operation, I gave you the example just now, investment in Australia, and then you borrow from Australia, then the fluctuation within Australia sets off the loan against the investment. All right. So instead of using Malaysian ringgit. And then cash flow hedge, entity expects to purchase US denominated inventory every 6 months. It enters into a forward contract to hedge the foreign exchange risk. So you lock in the US dollar, so you will not have a loss. If you have a gain, you don't get the gain. But then if you have a loss, you don't lose the money. So what people want to have in the account is a more stable, all right? You don't want to have a risk of What if it gains? I don't want to take. But what if it loses? You cannot. All right. So the accounting outcome is effective portion, OCI, reclassified to P&L when the inventory affects the profit. So when you take out the hedging risk without purchasing, it goes to OCI. But once you purchase it and the actual foreign exchange kicks in, then it goes to P&L. All right. That is the special rule. Hedge accounting is not speculation. It is a disciplined risk management. Explain to the student. It's not a speculating thing. It is a disciplined risk management to overcome fair value changes or currency changes. What you should emphasize versus what you should avoid. Emphasize economic substance of the transaction. It must have economic substance, value. There must be a judgment and estimate, and the basis between the judgment and the estimate. There must be a link between the numbers that you've come up with and the disclosure for the user to read. What we should avoid, don't go and do complex hedge effectiveness testing. Hedge effectiveness testing is possible to be done. All right, it's very complicated. You don't have to do it at all. Many companies don't do it. Some very big banks do it, but it is very complicated. If you join a bank, they will teach you their method of doing the hedge effectiveness, but you just don't have to learn this, right? Actuarial, actuarial probability of default and also loss given default calculation. Don't go and tell them how to do actuarial calculation. We are not an actuarist. All right, just do the simple one we saw. Excessive IAS 39. Don't compare with the old IAS 39 or the MFRS 39. That is a dead and buried. Some people are still living in that age. They think that, MFRS 139 is still alive. It's no more. The whole concept has changed. So ECL is forward-looking, judgment-based. Disclosure are not secondary, but fundamental. Hedge accounting should be taught as a conceptual tool, not a calculation exercise. All right. So I've gone through this already, probably of default, everything. So I've more or less covered everything in the slide and also on this.
Thank you, Mr. Selva, for your presentation. Ladies and gentlemen, this is the end of the 17 MIA-ACCA Train the Trainers. A kind reminder to all of you to complete the evaluation form. Kindly click the link in the chat box or you can scan the QR code at the screen. Thank you everyone for attending this webinar. Wish you well and hope to see you in our future events. Stay safe, stay healthy, and thank you everyone.